Benjamin Graham is an absolute icon in the investing world, and his life story is
Yeah.
fascinating in so many ways. He transformed what used to be a kind of superstitious, ritual-packed world into like a modern, analytical approach to investing.
Right, and what's really striking is how his ideas, like the notion of stocks representing actual ownership in a business, really shifted the mindset of everyone on Wall Street.
Exactly. It's like he peeled back the mystique that shrouded investing. Before him, money managers operated much like, I don't know, a medieval guild with rituals and all that guesswork.
Mhm.
Then along came Graham with his security analysis, and of course, the intelligent investor.
Yeah, The Intelligent Investor, it's basically the Bible for individual investors, isn't it? The first book that, gives you the emotional and analytical framework for financial success.
Absolutely. And it's not just about picking stocks. It's about being a realist. Graham taught us that the market is like a pendulum swinging between extreme optimism and deep pessimism. You, in a way, win by selling to optimists and buying from pessimists.
Right. That's a neat way to put it. But could you break down what he meant by margin of safety? It always seems to be such a crucial concept.
Yeah, so the margin of safety is basically about never overpaying for an investment. It's like saying, no matter how exciting something might look, hold back to protect yourself in case you're wrong. That cushion, that extra buffer, it minimizes the risk of error.
Yeah, I get that, but sometimes I wonder, isn't there a risk of being too conservative with your investments? Like, if you always insist on that safety cushion, could you be missing out on growth?
That's a fair point, and it's something investors debate even today. But Graham argued that the price you pay directly affects your return. If you overpay, no matter how alluring an investment seems, you're setting yourself up for lower returns.
Right. I see. It's almost like he believed that sound judgment and discipline in your decision making are more important than chasing quick gains.
Exactly. Graham's whole philosophy was built on the idea that your behavior, your discipline, and your critical thinking matter more than what the market does. It's a bit like saying, it's not the roller coaster of the market that defines your success. It's how you handle the ride.
Yeah, that makes a lot of sense, especially considering how volatile markets can be. What's also interesting is he wasn't just an academic. His real-world experiences, like going through huge losses himself, really shaped his thinking, right?
Oh, absolutely. Graham's personal history is almost like a case study in both fortune and hardship. His family went from living on luxury Upper Fifth Avenue to facing poverty when circumstances turned bleak after his father's death and the porcelain business failing.
Yeah, and that personal experience of witnessing financial ruin firsthand, especially with his mother's mishap during the crash of 1907, that must have driven home the importance of careful money management.
Absolutely. It's like, he experienced firsthand the humiliation and the harsh reality of financial loss, like cashing that check and hearing the teller ask if his mother was good for $5. That kind of public embarrassment forged his resolve to never let emotions dictate his decisions.
Right on. And his academic prowess, winning a scholarship at Columbia, and then having multiple departments vying for his talents, shows he was like a real prodigy. But he chose Wall Street over academia, right?
Yes, that's the intriguing part. At just 20, he was already in demand as a teacher, but he decided to dive into the practical side. Wall Street. He started from the bottom as a bond trader clerk and worked his way up to running his own investment partnership.
Interesting. I guess his hands-on experiences helped solidify the strategies he later became famous for. And speaking of strategies, his approach to detailed research was groundbreaking, wasn't it?
Oh, definitely. Graham was a master at diving into molecular level details about companies. There's that famous example, Northern Pipeline Co. In 1925, he noticed it was trading at $65 a share, yet it held over $80 a share in high-quality bonds. He basically turned that into a profit by pushing for a higher dividend and reaping the rewards 3 years later when it climbed to $110.
That's pretty impressive research. But don't you think some might say that in today's fast-paced market, such deep dives might be too slow?
I get that criticism, but Graham's approach is all about building a fortress around your investments. Sure, markets move fast, but his method of detailed research created a buffer against volatility. It's like building a house with extra strong foundations versus a flimsy fabric structure.
True. I see your point, and his track record speaks for itself, right? Even after a near 70% loss during the Great Crash, he still managed to thrive afterward.
Exactly. From 1936 until he retired in 1956, his firm achieved annual gains of around 14.7% compared to 12.2% for the market. That's not just luck. It shows how his principles, like the margin of safety and disciplined research, truly stood the test of time.
It's kind of prophetic, too. Graham warned all along that every bull market had an expiration date. You know, his early conviction that all bull markets must eventually end badly?
Yeah, that's one of the most striking aspects. His certainty, even when many investors seem to be caught up in the euphoria, really resonates now, especially given the boom and bust cycles we've seen over the decades.
Absolutely. I also like how his ideas have been carried forward in modern interpretations. The revised editions of The Intelligent Investor even include contemporary examples to show how his timeless principles still apply today.
Right, and that speaks volumes about the universality and longevity of his insights. His core message: invest wisely, think critically, and never let emotions drive your decisions, is as valid now as it was back then.
Yeah, I guess that's what makes his work liberating. It empowers individual investors to take control of their financial destiny rather than being swayed by market mood swings.
Exactly. With Graham as your guide, you develop not just strategies, but a whole mindset. It's not just about the numbers. It's about understanding your own behavior and building the patience and discipline needed to succeed.
Right. So if you were to sum it up, it's like Graham taught us that the future value of every investment is a function of its present price, and that no matter how careful you are, there's always a risk of being wrong unless you have a margin of safety.
Exactly. And that's the cornerstone of his philosophy. By always insisting on a margin of safety, you significantly reduce your chance of error. It's about embracing a mindset that values patience, critical analysis, and a realistic perspective on market fluctuations.
Now, let's talk a bit about his legacy. How do you think Graham's teachings have shaped modern investment strategies?
Oh, they've had a massive impact. I mean, modern value investing, especially as popularized by people like Warren Buffett, really owes a lot to Graham's approach. His ideas revolutionized the field by shifting the focus from pure speculation to a more methodical, research-driven approach.
Yeah, that's evident. It's interesting, though. Some might argue that today's market dynamics, with high-frequency trading and such, might render his methods somewhat old-fashioned. What do you think?
That's a compelling point, and I get the skepticism. But here's the thing. The underlying principles of risk management, value assessment, and disciplined investing are as critical as ever. Markets may evolve, but human behavior and the need for prudent decision-making remain constant.
Yeah, it's like, while the tools and technologies change, the psychological aspects of investing, fear, greed, over-optimism, remain pretty much the same.
Precisely. Graham understood the psychology behind the market swings, which is why his advice to be a critical thinker has endured. It's like, he taught us that our financial success is more about who we are as investors than the unpredictable nature of the market.
And it's fascinating how his life experiences, from early hardships to triumphs on Wall Street, contributed to his unique perspective on risk and opportunity.
Right. His journey really encapsulates the idea of turning personal adversity into wisdom. You know, it's like his early struggles with poverty and personal humiliation gave him a grounded view that no matter how good the opportunity looks, without discipline and margin for error, you're setting yourself up for a fall.
I can totally see why Graham remains so revered today, especially for individual investors who are trying to navigate the sometimes overwhelming world of finance.
Absolutely, and in many ways his work continues to empower people, not just by teaching investment strategies, but by fostering a mindset that champions rationality and self-confidence. It's like with Graham's ideas, you learn to trust your own judgment instead of following the crowd.
Yes, indeed. So whether it's during a market rally or a downturn, his emphasis on disciplined analysis and a margin of safety provides a roadmap for staying calm and making smart choices.
Exactly. And that's why even after reading his work multiple times, each read seems to offer new insights and reinforce that timeless wisdom. With Graham guiding your thoughts, you're more prepared to face whatever the market throws your way.
Right, absolutely. It's really inspiring to see how one man's vision could reshape the entire financial landscape. And it just goes to show that in investing, just like in life, having a solid philosophy and a bit of skepticism can go a long way.
Definitely. It teaches us that ultimately our success in the markets relies not on blind optimism, but on thoughtful strategy and self-discipline. And if you can internalize that, you're already ahead of the game.
I guess that's the enduring legacy of Benjamin Graham. His ideas continue to educate and inspire investors to think critically, act with confidence, and never let market emotions cloud their judgment.
Right, it's a legacy that's as relevant today, especially in our fast-changing markets, as it was over half a century ago. Every investor can benefit from a little Graham wisdom in their portfolio.
Right. Well, it's been enlightening discussing these insights. The blend of historical context, personal struggle, and groundbreaking investment theory really makes Graham's story a masterclass for any investor.
Absolutely. Here's to having the courage to think independently and invest wisely, just as Benjamin Graham taught us. Thanks for diving into this with me.
Yeah, thanks for the talk. Looking forward to our next deep dive into another timeless topic. Until then, keep questioning and investing smartly.
Welcome to the discussion, everyone. Today, we're diving into a classic perspective on investing, one that emphasizes solid principles over chasing the next hot tip.
I'm ready for this deep dive. What strikes you first about this approach?
Well, the text lays out that the aim isn't to tell you how to beat the market through a magic formula, but rather to build an investment policy based on sound principles that any layperson can adopt. It's all about minimizing irreversible losses and managing risk.
Right, so it's not about speculative get-rich-quick schemes. It sounds more like a guide to cultivate a disciplined attitude.
Exactly. And it's interesting how the text distinguishes between investors and speculators. Defensive investors focus on avoiding mistakes, while enterprising ones might dig deeper for a bit more profit, but always with caution in mind.
Yeah, and they emphasize that any so-called technical approach where people buy high after a rise and sell low when they see a dip is essentially inverted logic. Correct?
Right on. The text underscores that business sense everywhere else is to buy low and sell high. But some traders follow the exact opposite by chasing momentum.
Absolutely. That's a point that really challenges a common mentality. It's like saying that if everyone is over-enthusiastic, you've got to be the contrarian.
Exactly, and it even provides historical comparisons to show why that approach doesn't work. For example, it reviews a case where a promising, albeit overly optimistic, forecast ended up delivering, well, much less than expected returns.
Oh yes, I remember that example. It compared predictions like turning small monthly savings into a huge sum, only to show that the real numbers were far less impressive. Quite eye-opening.
Absolutely. That example involving Rascorb shows that blindly following optimistic forecasts without a solid policy can lead to major disappointment. It's a clear reminder that numbers don't lie, and you must ask how much every time.
And it really brings home how crucial it is to understand historical market behavior. Knowing past trends is like having the blueprint of what might repeat, right?
Definitely. The author, like Graham, reminds us with Santayana's famous line about remembering the past. It's not about predicting the future, but understanding that market behavior tends to cycle through ups and downs,
Right.
sometimes dramatic ones.
Now, there's also this whole discussion on the emotional and psychological barriers. The idea that even the smartest minds can, and often do, get overridden by their own emotions.
Oh, for sure. It's rather fascinating that being an intelligent investor, as defined here, isn't about raw IQ, but about emotional discipline, patience, and self-awareness.
So even someone with a brilliant mind, like Isaac Newton, can go wrong if he lets the crowd dictate his behavior. That's almost ironic, given his achievements elsewhere, wouldn't you say?
Right. The anecdote about Newton is a classic cautionary tale. Here we see that regardless of how intelligent someone is, failing to control one's emotions, in this case, allowing the market frenzy to override judgment, can lead to disastrous results.
And the book seems to drive home that lesson repeatedly, that the worst enemy for an investor might be themselves.
Absolutely. It's like it's saying, focus on establishing a solid policy and always act with reason rather than passion. Quite a contrast to the speculative mindset on Wall Street.
Yep. I also found it interesting how the discussion touches on the difference in bond yields versus stock yields. There's a significant point made about the advantage of bond yields at that time.
Yeah, it hints at a shift in the financial climate around the early 1970s. Back then, high-grade bonds were starting to yield much more compared to stocks. For example, at one point, bonds were yielding over 7%, while industrial stocks were only returning a few percent.
Exactly. That presents a bit of a puzzle. Should a cautious investor jump entirely into bonds until the situation reverses, or stick to a balanced approach?
That's a classic debate. The text suggests maintaining a balance. In previous editions, a 50-50 split was advocated, though it questions if, under such circumstances, one might lean more into bonds. It shows that sound investment principles should adapt to changing market conditions without abandoning the core idea of buying at reasonable prices.
Speaking of buying, the text seems to advocate for purchasing stocks not too far above their tangible asset value, doesn't it?
Yes, exactly. It's a practical, almost old-school approach. Buying stocks near their net asset value gives a safeguard. If the market becomes irrational, you're still holding on to something that is reasonably valued. It's a policy that prevents overexposure to the speculative highs.
But wouldn't that approach limit the growth potential in a booming market? Some might argue that chasing growth stocks, even if overvalued, leads to higher rewards.
That's an interesting point, but then the text also cautions that chasing growth can trap you in the emotional roller coaster of market highs and lows, increasing the risk of big losses. It fundamentally challenges the notion that true intelligence in investing is about making aggressive bets on booming sectors.
True, though I think there could be room for debate on that. So are you saying that while aggressive investments might pay off sometimes, over-reliance on them is a recipe for disaster?
Yes, exactly. The book suggests that while some enterprising investors might chase better returns with a bit more risk, the average investor should, for his own sanity and security, stick to the principles of safe, defensive strategies.
And what about the commentary on market cycles? It mentioned phenomena like the dot-com bubble and then the severe declines that followed.
Right. The commentary drives home that whether it's a soaring bull market or a falling bear market, every cycle comes with its own challenges. It reminds us that even super high expectations, like those from tech booms, can be utterly misleading. There's this clear message: never get swept up in market hype.
Right. It's tough, isn't it, to keep a cool head when everyone around you is either euphoric or panicking.
Definitely. And That's where the psychological tone of the text becomes so important. It's like saying that an investor must have the emotional strength to stick to a plan regardless of market
Yeah, that's
noise.
key. And that's what, in many ways, separates the intelligent investor from the rest, isn't it?
Precisely. Intelligence in this context is about character over raw intellect. It's about patience, self-discipline, and the ability to learn from past mistakes, because history shows time and again that reckless exuberance just leads to loss.
Exactly. I'm also fascinated by the commentary's nod to specific historical financial calamities, like the losses suffered by long-term capital management and even earlier events. They serve as stark warnings.
Yes, those examples are almost like cautionary folklore for modern investors. They remind us that even experts with all their resources can falter if they ignore fundamental principles. It's a reminder to stick to what works, like avoiding irreversible losses by being fully aware of what you pay for.
Right, absolutely. So, wrapping this up, the book's overall thrust seems to be about carving out a sensible, well-informed investment approach that balances safety with modest growth. Would you agree?
Yes, that's the heart of it. It emphasizes that intelligent investing isn't about chasing miracles. It's about surviving market swings, knowing historical patterns, and most importantly, controlling your own behavior. It's a guide to invest in a way that builds long-term wealth without falling for every market fad.
Yep, that makes a lot of sense. It certainly offers a powerful counter-narrative to some of today's more reckless financial practices and reminds us that sometimes the simplest strategies are the best.
For sure. And as we continue to see market cycles and unexpected events, this lesson remains as relevant as ever. Sound investing is less about making a quick fortune and more about fostering a mindset of resilience and rationality.
Exactly. I really appreciate how the text also explains that managing risk is not just about numbers, but about self-awareness and discipline. That definitely sets it apart from typical investment advice.
Absolutely. It challenges the norm by saying, hey, your own behavior might be your biggest liability. And that, in turn, pushes us to think differently
Right.
about how we approach market trends.
So, what would be one key takeaway for anyone listening today?
The key takeaway is that intelligent investing means being cautious, self-disciplined, and patient. It means, as the commentary puts it, building a foundation before you try to build big castles in the air. And always remember to ask, how much before making any investment decisions?
Yep, that really nails it. Thanks for unpacking these insights. This has been a really enlightening conversation that challenges common assumptions while reminding us of timeless principles.
Absolutely. Stick to these principles and you'll be much better prepared to navigate the often unpredictable markets. Thanks for joining in on this discussion.
It was a pleasure. Here's to crafting smart strategies in a world of market noise.
Welcome to our discussion on distinguishing investment versus speculation, based on some key ideas from a classic text. Let's dig into the contrast between strategies that promise safety of principal and adequate returns versus those that are essentially speculative gambles.
I'm ready. There's so much to unpack here. What's the big difference really between an investment and a speculation?
Well, it's pretty clear. An investment, when properly analyzed, assures both safety of your money and a reasonable return. Speculation, on the other hand, is more like betting on a price move without underlying assurance.
Yep.
That's the big picture.
So, in essence, investing is all about the underlying business performance, whereas speculating gets entangled in, say, emotions and market hype, right?
Exactly. And as the text points out, while everyone on Wall Street might call themselves an investor at times, many are really speculating, trading without reaping careful analysis of the business fundamentals.
Yeah, true. Right, and it's interesting how this distinction evolved over decades. Back in 1934, they really hammered home that concept. But later on, especially with the market roller coaster of the mid-20th century, the labels got blurred, didn't they?
Absolutely. After the 1929 crash and through subsequent crises, Even common stocks were seen as speculative by many. It wasn't until later that they tried to reclaim the term investor for more sensible practices, where, one actually looks at corporate fundamentals rather than just chasing trends.
Mm-hmm. And that bubble of speculation isn't just in the distant past, is it? I mean, even in more recent times, ideas like day trading have taken off, right?
True, and that brings us to another core idea: the defensive investor who's more cautious. This person splits their portfolio, typically between high-grade bonds and leading stocks. The aim is to be prepared for market swings while still capturing some growth.
Yeah, so defensive investing really recommends a balanced approach, like a 50-50 split with room to shift if market conditions change.
Exactly. The advice is that a defensive investor should always maintain critical exposure to bonds, since bonds yield a more stable return and protect the principal. Even if stocks might seem to offer higher returns at times, with all the ups and downs, bonds sort of cushion the blow.
Mm-hmm. That makes sense. And then on the other side, there's the aggressive or enterprising investor. That's where some try, more energetic stock trading or even short selling. But the text warns that even intelligent speculating is a slippery slope if not done right.
Right. The aggressive investor might try to outperform the market by using tactics like trading based on very short-term signals, yet several dangers come with that, like overtrading, which often ends up benefiting the brokers.
Yep. It's like, when you're at a casino, you might briefly win big, but eventually the house always wins.
Exactly. And it's interesting, the text emphasizes that speculating, like a casino gamble, can be fun when you're ahead, but it often nearly assures losses in the long run, because you're often acting on emotions rather than hard analysis.
I get that. Speaking of emotions, there was this commentary on the reckless investor, or the so-called speculator, where the common jargon dilutes the true meaning of investing. It's almost like calling everyone on the trading floor an investor without distinguishing the risk levels.
That's spot on. The text critiques the tendency to call every transaction an investment, whether it's well thought out or just quick trading. Investors are advised to stick to companies with a proven track record and not to get swept up in speculative frenzies.
And there's a neat illustration where they discuss how, for instance, an inexperienced person could even try to sell shares they don't own, thinking they can buy them back cheaper later, which is a risky move indeed.
Yes, that's a great point. Selling short without proper backing is pure speculation. And let's be honest, it's often done without any thorough underlying analysis, which is a recipe for disaster.
Right, definitely. Now, what did you make of the part where the text explains the portfolio mix? It seems like their recommendations changed over time due to interest rate movements and market conditions.
Absolutely. For defensive investors, there was that idea of maintaining at least 25% and at most 75% exposure to stocks, keeping in mind that bonds typically promise more security. For instance, earlier, the expected combined return might have been around 7% per year, but then interest rate fluctuations, especially after 1964, influenced what could be safely expected from bonds versus stocks.
Mm-hmm. Yeah, and it's interesting how the return expectations from bonds shot up due to higher interest rates. It really shifted the balance in favor of bonds in some periods, even though stocks might have offered a bit more growth potential on paper.
Exactly, and that's one of the most critical insights. No one can reliably predict the exact future of stock prices or even bond yields. It forces investors to diversify and be prepared both psychologically and financially for short-term volatility.
Right, and then there's the aggressive investors who try various formulas and strategies to beat the market. I recall the discussion about the Foolish Four and the January effect. What are your thoughts on those?
Oh, those are fascinating examples. The Foolish Four was one of those quirky formulas. The idea was to pick a couple of stocks based solely on low prices and high dividend yields, then drop the best one and overweight the next best one, an approach that completely ignores thorough analysis.
Yeah, right. And it's clear that such formulas are more about riding on random statistical flukes than any solid predictive reasoning.
Absolutely. And then we have the January effect, where investors try to capitalize on tax-driven selling at the end of the year, expecting a rebound in early January. But as more people jump on the bandwagon, the effect diminishes.
I hear that, yeah.
It's a classic self-defeating strategy.
I remember the text mentioning that transaction costs on very small stocks can eat up the slight gains even if the effect is there. It's almost ironic that what seems like an easy win is lost in all those fees.
Exactly. And here's where the importance of sticking to, fundamental analysis stands out. Investing should be to the extent that you're comfortable holding the security without obsessing over its daily
That's
price
key.
movements.
Now, I have to ask, you mentioned diversification earlier, but isn't it sometimes said that more concentrated portfolios, like the ones aggressive investors use, might yield higher returns?
Well, yes, but here's where I respectfully challenge that point. Even though concentrated positions could, in theory, generate higher returns, they also increase risk significantly. The text, and Graham's view, strongly suggests that keeping the risk manageable is paramount. Putting no more than, say, 10% of your wealth in your mad money speculative account can be a sensible rule.
Right, I see what you mean. So it's really about balancing the desire for higher returns with the need for security and steady growth.
Precisely. Defensive investors are encouraged to be modest in return expectations and to stay away from flashy schemes that promise astronomical figures with little safety. And aggressive investors must always remember that outsmarting the market isn't a sure win. They must base their moves on sound analysis rather than just market hype.
Exactly. This reminds me of the analogy comparing investing to a well-built casino that, if approached properly by adhering to the rules, won't bankrupt you, unlike reckless day trading.
Yes, it's like investing is such that if you stick to tried and true methods of thorough analysis, rational risk-taking, and maintaining diversification, you'll, eventually build wealth over the long term. Meanwhile, speculative practices are it's like betting on a roulette wheel.
Exactly, yeah. And then there was the commentary about how stock trading, especially online trading, transformed the way people experience the market. It became so fast-paced, even reducing average holding periods drastically.
Right. Back in the early 70s, stocks were held for years. But by the turn of the millennium, turnover rates skyrocketed. It's a clear sign that the hype and technological innovations made speculation far more accessible, but also far riskier.
I know, it's crazy. Exactly. That transition turned many into what some call speculation nation, where the focus shifted from solid investing to quick and often reckless trades.
And that's really what Graham warns against. The so-called hot issues rarely live up to the promises of quick profits and often just end up boosting broker revenues at the expense of the investor.
It's almost a cautionary tale. If something sounds too good to be true, like turning a small sum into a fortune by some quick trick, it probably is.
Exactly. And in today's world, with all the day trading apps and online brokers hyping up these fast moves, it's important to keep these principles in mind. Not just chasing immediate gains, but instead building long-term, well-thought-out investment strategies.
Very true. So, would you say that the central takeaway here is to separate your speculative money from your investment capital and always stick to the fundamentals?
Yes, exactly. The advice is to keep speculative operations to a tiny part of your portfolio, like 10%, and let your main defensive core consist of solid, well-researched investments that can weather market ups and downs.
Sound advice indeed. In the end, it's about protecting your principal while still aiming for a return that's, adequate but not overhyped by speculative fervor.
Exactly. And with that, we wrap up the discussion on the difference between intelligent investing and reckless speculation, a timeless reminder that consistent success in the market comes from disciplined, rational analysis rather than chasing trends.
Absolutely. Thanks for the insights.
Let's dive into how inflation impacts investment choices, particularly for those watching their fixed incomes versus those holding stocks. The analysis really emphasizes that while bonds suffer from eroding purchasing power, stocks have, in some cases, managed to compensate through rising dividends and share prices.
Right, so we're really talking about how inflation forces investors to reassess where they keep their money. Fixed dollar incomes just don't cut it when living costs surge, right?
Absolutely. It's like, imagine your wages are fixed while the cost of your groceries rises steadily. That disparity really drives home the importance of choosing assets that can at least partially offset inflation.
Yeah, I find it fascinating how historical analysis, starting from as early as 1915 up until the early 70s, shows that there's been a significant oscillation in the price levels. You had periods of steep inflation and even deflation. How do you see that influencing investor decisions today?
Well, the historical evidence tells us that inflation is not a one-off phenomenon. It's something that recurs. Even though recent government policies are aimed at controlling it, the data, like the average consumer price rises of 2.5% over 20 years and spikes like 5.4% in 1970, suggest that expecting a moderate inflation rate, say around 3%, is a safer bet.
Right, exactly. But then there's the debate about bonds versus stocks. Many experts argue that inherently, bonds become undesirable in an inflationary environment because fixed returns lose real value. So the suggestion is often to lean towards stocks. What's your take on that?
I think it's a bit more nuanced. Stocks, while they can cope with inflation through increased dividends and share price growth, haven't always outperformed bonds in certain periods. For example, the analysis points out that even though the DJIA grew at around 4% annually, with dividends it nudged to 8%, that return doesn't necessarily beat the bond market's yields in specific market conditions.
So do you feel that the conventional wisdom of stocks are your best inflation hedge might be a little oversold?
Exactly. It's not a one-size-fits-all solution.
Yeah, indeed.
The inherent volatility and the fact that inflation's impact on corporate earnings isn't direct, stocks often underperform in both high inflation and deflationary times, makes the decision to go all in on stocks a bit risky.
Right. Speaking of corporate earnings, one of the key points was that rising inflation didn't directly boost per share earnings. Despite a 40% increase in wholesale prices over decades, earnings didn't automatically climb. That points to other offsetting influences like rising wage rates and increased capital requirements, doesn't it?
Yeah, absolutely. It's like, even though costs go up, companies can't simply pass everything on without repercussions. For instance, between 1950 and 1969, corporate debt expanded nearly fivefold, while profits barely doubled. So inflation can even work against companies if they rely too heavily on debt.
Right. That's a sharp observation. And honestly, the growing ratio of debt relative to earnings is a concern. It makes one wonder if the rise in stock values is built on a shaky foundation at times.
Exactly. It's like constructing a house on quicksand. Even if the stock market looks attractive at first glance, if it's being propped up by unsustainable debt levels, it's just adding to the risk.
Yeah. Now, what about the alternatives to stocks? The discussion brought up the classic inflation hedge, gold, but then it pointed out that gold hasn't really kept pace since 1935, rising only about 35% over 35 years, and it doesn't offer any income return.
Right. Investing in gold might feel like a safe bet as a store of value, but when you factor in the missed opportunity for earning interest, as well as storage costs, it often turns out to be a lower return proposition compared to even well-managed savings accounts or bonds.
And what about real estate? It's been touted as a solid, long-term inflation hedge despite its own fluctuations.
Real estate does offer some insulation against inflation, mainly because property values and rents tend to rise over time. However, you run into issues like location risks, high transaction costs, and the challenge of diversification if you're a moderate investor.
Right. I guess diversification really becomes key here. Rather than putting all eggs in one basket, whether that's stocks or bonds, you need a mix to mitigate risks. Is that how you see it?
Absolutely. Diversification is fundamental. The concept here is to balance the portfolio so that any erosion of purchasing power in one area is cushioned by gains in another. For example, bonds might be more stable, albeit less inflation-proof, while stocks provide growth potential but are volatile.
Yeah, that balance is crucial because, let's face it, you can't measure success by just looking at nominal returns. The money illusion plays a big role here, where investors are dazzled by high nominal numbers, but miss the real after-inflation picture.
Exactly, that's one of the key points. Even a 2% raise feels great if inflation isn't eating away at your buying power, but if inflation runs at 4%, you're technically worse off. It's like we need to look at both the nominal and the real returns to truly understand the outcome.
Right, definitely. And it isn't just about the average returns over decades. There's also the psychological impact on investors over shorter periods. A bull market might make you overly optimistic about inflation, while a bear market might just as easily push you into panic selling.
Yes, the volatility of short-term outcomes means that even if stocks average an 8% return annually over the long haul, the investor might experience several tough years. For instance, it took General Electric and even the entire DJIA 25 years to recover from the 1929-1932 collapse.
Yeah, that's true. It seems that both the long-term averages and the short-term fluctuations need to be managed carefully. So, what then are the newer alternatives on the scene to help fight inflation?
Well, over the last few decades, two major instruments have become popular: REITs and TIPS. REITs, or real estate investment trusts, offer exposure to real estate without the headache of individual property management. They're bundled into funds,
Right.
and while no tool is perfect, they tend to track inflation moderately well.
And TIPS, Treasury Inflation-Protected Securities, are essentially bonds that adjust for inflation, right? They automatically go up in value when inflation rises, although there's that tax twist.
Exactly. TIPS are pretty neat in that regard. They provide the security of a US government bond with automatic inflation adjustments. But, as you mentioned, when the bond's value increases due to inflation, the IRS considers it taxable income, even if you never actually sell the bond.
That's a drawback. That tax issue means they work best in tax-deferred accounts, like IRAs or 401ks, right? Otherwise, you might end up paying taxes on gains you haven't cashed in.
Absolutely, exactly. So TIPS become a sort of insurance policy against inflation for a portion of your portfolio, requiring careful tax planning.
Yeah, it's interesting how the analysis ultimately suggests that there isn't a one-size-fits-all solution. While stocks are seen as the lesser evil compared to bonds in an inflationary environment, neither exclusively provides a bulletproof hedge against inflation.
Right, and that's the crux of it. The recommendation is to maintain a diversified portfolio, a blend of high-grade bonds, common stocks, and some allocation to instruments like TIPS and REITs. This way, you're prepared against an inflation spike without being overly exposed to any one risk.
I'd like to challenge one point here. Some might argue that in times of truly high inflation, common stocks should automatically outperform bonds because companies can raise prices. But the data doesn't always back that up, does it?
That's a fair challenge. Turns out that during severe inflation spikes, like when inflation exceeded 6%, stocks tended to perform erratically and sometimes even lost value. It's almost paradoxical. Companies can pass on costs to customers, but then consumer spending drops off due to the overall higher prices.
Yeah, that's the tricky part. So, in practice, the investor really ends up in a predicament where no single asset class is perfect. The intelligent approach is to hedge across multiple assets, accepting that there will be fluctuations over time.
Exactly. It's like you're constantly juggling different asset classes to offset the impact of inflation. The key is not to overreact to short-term movements, but to ensure that over a longer horizon, your portfolio retains its purchasing power.
Right on. I also find the commentary on the money illusion quite compelling. Investors can easily be misled by attractive nominal returns without realizing that inflation might have eaten away a significant portion of those gains.
Yes, that's a crucial takeaway. The real measure of success is how much you keep after inflation, not just the headline number. That's why it's so important to always consider the real rate of return when evaluating investments.
Indeed. So summing up, it sounds like the layered approach, mixing bonds, stocks, tips, and REITs, is recommended for most investors, particularly the defensive investor who can't afford major risk swings.
Absolutely, and it's all about accepting that inflation is a persistent, sometimes unpredictable force. The investor might do well over the long term, with an average return of about 8% on a diversified stock portfolio, but the journey can be bumpy. Balancing risk with instruments that offer some protection, like tips and REITs, is essential.
Exactly. While the past doesn't guarantee future performance, understanding these dynamics can help investors build a resilient strategy. In the end, it's about keeping the real value of your wealth intact. This mix helps guard against both the devaluation of money and the capricious nature of markets.
Well put. The nuanced view here is that there's no magic bullet. Instead, it's a thoughtful blend that offers defense against the sometimes invisible, yet very real, threat of inflation.
Yeah.
Thanks for the great discussion.
Absolutely. It's been enlightening diving into the interplay between inflation and various investment challenges. Let's catch up next time with more insights.
Welcome to our podcast session. Today we're diving into a detailed look at a century of stock market history, looking at cycles, indices, price-earnings ratios, and the cautionary tales that shape investment strategy.
I'm ready to jump in. So, we're talking about over 100 years of market swings, right?
Exactly. The content takes us back as far as 1871, when useful statistical data on prices, earnings, and dividends starts, and it covers the evolution up to early 1972. Yep. There's a real emphasis on understanding the cycles crudely mapped out in tables and charts, including comparisons between the Cowles Standard 500 Composite and the Dow Jones Industrial Average.
That's fascinating, especially when you consider how these early benchmarks set the tone for modern investing. So what's the big takeaway from those early cycles?
Well, one of the key points is that the market has progressed through distinct phases. The first phase, from 1900 to 1924, showed relatively short market cycles, with an annual advance averaging around 3%. Then you have the new era bull market, culminating in 1929, with a dramatic collapse right after.
It's almost like an oscillating heartbeat, steady growth, then sudden drama. And then I understand there's the recent phase leading us up to early 72.
Right. The final segment in this chapter illustrates how after some very turbulent cycles, especially the setbacks of 1969 to 1970, the market rebounded to new highs. But the analysis is very layered. It doesn't just look at stock prices, but dives into earnings and dividends. For example, the average returns in the post-World War II era are significantly higher than in the earlier periods, except, of course, in the 1960s, when the advance was slower than the 1950s.
That's an interesting point. So, does the content suggest that timing is everything when it comes to picking these cycles?
In a way, yes. The analysis repeatedly stresses the importance of not simply extrapolating past returns into the future. You see, the chapter highlights earlier analyses from 1948, 1953, and 1959. In 1948, for instance, the market's level seemed reasonable relative to underlying values. By 1953, despite a 50% gain in 5 years, there was uncertainty about whether current high levels were too risky.
Right. And then in 1959, they even labeled the levels as dangerous, correct?
Yes, exactly. When the DJIA hit 584 in 1959, they cautioned that prices were far too high. It's like they were saying, be careful, don't let excitement lead you to undercut sound judgment. And later, in 1964, when prices edged up to 892, they warned again, suggesting a cautious policy. They even laid out specific actions. Avoid borrowing to invest. Shake out some of those common stocks if they're more than 50% of your portfolio, and be very wary about starting new dollar cost averaging in that high range.
Yep. It's almost a precise balance, isn't it? They're not telling investors to panic, but to proceed with deliberate caution.
Exactly. And one interesting observation is that despite these periods of high optimism, the actual long-term growth projections were far more modest. Even with the periodic ups and downs, the model suggests that a typical annual stock return might be around 6% or 4% after inflation. It's a humbling reminder that no matter how high the expectations are, reality often pulls the rug out from under us.
I can totally see that. It's like expecting a fireworks display every night. But really, it's more like a steady candle flame that sometimes flickers.
That's a great analogy. It's like the market is a roller coaster with gentle slopes and sudden drops. But overall, the ride isn't as wild as forecasted exuberance might suggest. And speaking of exuberance, the text goes on to discuss what happens when investors become overconfident, especially in the context of bull market baloney.
Right. Yes, I remember that part. There's a section that criticizes the notion that stocks can be, almost magically, assumed to always outperform bonds simply because they have in the past.
Exactly. Graham challenges that logic head-on. He criticizes predictions that, for example, stocks would inevitably reach heights like 36,000 or 100,000 on the Dow. His argument is that the value of any investment is driven by the price you pay for it. You can't pay, say, 10 times what's reasonable and then expect to double your returns over decades.
That reminds me of the Michael Jordan analogy. The idea that even the greatest can't justify an astronomically high price tag.
Right, like saying you'd never pay an insane premium for even the best player. Just because a company's prospects are bright doesn't mean you should pay like 10 times earnings compared to more modest multiples historically. And then there's the whole shifting relationship between dividend yields and bond yields. In the early days, stocks yielded twice as much as bonds, but by the early 70s, bonds yielded more than stocks.
That's a critical point. It's almost like the financial climate flip-flopped, and that should, in theory, make investors rethink how they value stocks relative to safer bond investments.
Absolutely. And here's where the analysis really gets into numbers. For instance, they compare the ratio of stock returns, calculated as earnings over price, to bond returns, and show how this ratio worsened by 1972 compared to earlier periods. This decline in relative returns led them to assess that market levels in early 1972 weren't too attractive for conservative investors.
I see. It certainly sounds like they wanted to make clear that market exuberance often leads to risky, lofty valuations that don't hold up in the long term.
Exactly. And note, they even reference later periods like the bear markets of 1973-1974 as a prophecy of sorts, warning that markets can and do correct dramatically when overextended. They pointed out that despite past bullish cycles, the market can always surprise you, often brutally.
That's a point I want to challenge a bit. Some might argue that past performance, especially when you aggregate many decades, could provide a robust basis for projections. Don't you think there's merit in that approach?
Sure, there's some merit, but Graham's argument is exactly that. You can't forecast future results solely by extrapolating past trends. Historical returns get averaged out, but they mask the dangerous short-term extremes. One period of exuberant buying might be followed by a period of equally dramatic losses. That hindsight bias can be misleading if you assume it will always turn out as it did in the calm averages.
Yeah, I get that. It's like relying too much on an old map when the terrain has changed. Historical averages provide context, but they don't predict the next twist in the road.
Exactly. And on top of that, there's the danger of survivorship bias. The content even touches on how indexes before 1871 only included a handful of companies that survived, neglecting the many that failed. So, historical stock returns might portray an overly optimistic picture compared to what actual investors experienced.
That's a really sobering thought. It really puts into perspective why conservative investors should tread carefully rather than chase the highest highs.
Precisely. And speaking of caution, the guidance laid out for investors in 1964 and echoed into the 1972 analysis was very specific. Avoid borrowing to invest, reduce the proportion of stocks in your portfolio if it gets too high, and stick to long-term disciplined plans like dollar cost averaging, rather than trying to time the market.
Yeah. It almost feels like a timeless investment mantra, doesn't it? Even as market conditions change, the underlying principle of not over-leveraging and being wary of market exuberance remains solid advice.
Absolutely. And another fascinating point is the evolution of the price-on-earnings ratios. For example, back in 1949, the S&P Composite sold at only about 6.3 times earnings, but by 1961, that ratio had ballooned to nearly 23 times. That dramatic shift reflects a huge change in market sentiment and often risk.
Wow, that's quite a jump. It sounds like investors in the 60s were getting way carried away with future prospects without sufficiently grounding them in the underlying earnings reality.
Exactly. And that's the heart of Graham's argument. Those lofty valuations often set the stage for inevitable corrections. And while sometimes you might get short-term rallies even at high PE levels, the long-term historical record shows that overpaying rarely
Right.
pays off.
It's amazing how these lessons from early 20th century cycles still feel relevant today.
They sure do. Graham's timeless advice warns us against the allure of perpetual high returns and reminds us that the market's exuberance is cyclical. Even though bullish predictions can be irresistible at times, caution and discipline are key to survive the market's ups and downs.
And I really like how he ties hedging expectations with the vast uncertainty of the future. Like, you never really know what's around the corner until the market surprises you, often when you're least prepared.
Exactly. And as he puts it, the only indisputable truth is that the future will always surprise us. This humility in forecasting should keep us from risking too much on overly optimistic views. It's a reminder that sometimes it pays to expect less in order to avoid huge disappointments.
That's a solid takeaway for both seasoned investors and newcomers alike. Instead of relying solely on past returns to predict the future, one should always consider the underlying factors like earnings growth, inflation, and investor sentiment. Yeah.
Absolutely. And by doing so, we can hopefully avoid the pitfalls of speculative excess and build a portfolio that navigates the roller coaster with a lot less drama. As cautionary tales from the 60s and the projections leading into 1972 show, even sophisticated market analysts can be caught off guard if they ignore these fundamentals.
So in the end, it really all boils down to understanding the market's cyclical nature, keeping a level head, and not being swept away by high-flying optimism. Thanks for breaking that down. It's been a lively and detailed discussion.
Welcome to the podcast. Let's dive into a discussion on constructing a defensive portfolio, where the balance between bonds and stocks is given deep thought and precision.
Absolutely, it's a fascinating topic. So, the foundation really starts with setting clear allocation guidelines, right?
Right, exactly. The idea is not to base the investment mix on age, but rather on the investor's temperament, financial circumstances, and even how much intellectual effort they can apply. Essentially, even though there's the traditional 100 minus your age rule, here the focus is on a disciplined, measured strategy.
And that's a critical shift in thinking. Instead of age dictating risk, it's about one's ability to handle market fluctuations emotionally and intellectually.
Yes, indeed. The recommended strategy outlines a stock allocation somewhere between 25% and 75%, with a kind of balanced, even 50-50 approach forming the core, especially for those who lean toward a passive style. That 50-50 split really serves as a safeguard when markets move wildly.
Exactly. Because when the market is bullish, many investors may be tempted to overcommit to stocks, leaving them too exposed when downturns hit.
It's like having a shock absorber for your portfolio. The guide suggests selling a bit of stock if its portion exceeds the target, say if it drifts up to 55%, then repositioning back to an even split by transferring funds into bonds.
And the reverse applies when stocks fall below the target, right? Using bond funds to buy additional equities.
Exactly. It's a process of rebalancing that forces you to take emotion out of the picture, replacing guesswork with a systematic approach.
Yeah.
This discipline is really at the heart of the defensive investor's method.
One thing that stands out is how the guide underscores the risks of trying to time the market. It really paints a picture of the pitfalls that come from reacting impulsively.
Right. People, when the stock market is roaring, might feel overly confident and add more to stocks. Yet when it declines, panic selling sets in. This behavior leads to buying high and selling low. And that's
Absolutely.
precisely what the rebalancing strategy combats.
And then there's the whole component regarding bonds. The text goes into depth on the various types: U.S. savings bonds, tax-free municipal bonds, high-grade corporate bonds, and so on.
Definitely. It emphasizes that the bond component should be tailored based on tax considerations and the maturity you choose. For instance, taxable versus tax-free bonds depend largely on the investor's tax bracket. A person
Right.
paying a high tax rate might benefit more from munis, even if their stated yield is lower.
Exactly. And don't forget the discussion on the maturity aspect. Short-term bonds offer less price sensitivity to interest rate changes, whereas longer bonds may yield a bit more, but come with greater risk if rates diverge.
Yes, it's a balancing act. The recommendation is, for most, an intermediate term, like bonds with maturities between 5 to 10 years, to hedge against wild swings. That intermediate path cuts through the extremes of risk and reward.
I do wonder though. Sometimes some experts argue that the surely low-yield savings bonds have unique benefits, but are they truly competitive in a volatile market environment?
Good point. The discussion indeed praises U.S. savings bonds for their safety, guaranteed principal, and liquidity options. But it honestly suggests they're best for investors with smaller capital, say under $10,000, because while they offer consistency, their return doesn't compete with what you might get from corporate bonds in a high-content yield environment. So it's a trade-off that really comes down
Yeah, I
to
see that.
individual needs and risk tolerance.
Absolutely. And speaking of trade-offs, the guide also touches on aspects like call provisions on bonds, which can limit the upside when interest rates are declining. This heads I win, tails you lose situation is interesting, don't you think?
Very much so. The call provisions are viewed negatively because they restrict the investor's ability to fully benefit from rising bond prices. If bonds are callable at a premium that's not sufficiently attractive, you're basically capped. Hence, the recommendation to consider non-callable bonds, even if that means sacrificing a bit of yield.
That's a notable safeguard for the defensive investor who values stability over chasing every percentage point of extra yield.
Exactly. And then there's the analysis of preferred stocks. The text argues that although there are good preferred stocks out there, their inherent legal and profit participation weaknesses make them less attractive unless they're bought on a bargain basis. Preferred stocks don't usually
Yep, that's
provide a
clear.
strong enough cushion unless the market conditions force the price to dip excessively.
On the flip side, common stocks have the potential for considerable growth, though they come with more volatility. So even a defensive investor should perhaps retain up to 75% in stocks if they have the resilience to weather downturns.
Exactly right. But for the vast majority, the rule of not holding more than 75% in stocks is suggested, especially since market downturns can be mentally taxing. The idea is to
And
have
as the
enough
discussion
cushion to
points
prevent
out,
emotional
panicking
decisions.
during a downturn is a major risk. Absolutely. It makes me think about the comparison made with behavioral finance here, where the challenge isn't just market fluctuations, but also managing our own reactions.
Right. And that ties back to the fundamental point. Financial risk also lies within ourselves, not simply in the market or the economy. This introspection is crucial because an investor's personal circumstances, such as career risks, family needs, or unexpected life changes, should guide
so
the
personal
asset
context
allocation
is everything.
strategy.
Let's talk a bit more about the rebalancing strategy, which really highlights the simplicity and discipline behind the defensive approach.
Sure. The suggestion is to reassert a target allocation periodically, say every 6 months, on dates like New Year's or the 4th of July. This systematic rebalancing helps maintain the preset percentages and prevents the drift caused by market rallies or slumps. It essentially
No more getting
forces you to
carried away
sell
by the highs
high
and
and buy
lows.
low automatically.
Yes, and I appreciate that because it takes away the guesswork. However, I might challenge the idea that such a mechanical system always works in an ideal way. Sometimes market conditions are so atypical that you might argue for a more flexible approach.
That's a fair critique. No tactic is foolproof, and even the 50-50 model might need adjustment if personal or market conditions change significantly. But the underlying principle remains: discipline beats impulse.
Exactly. And interestingly, the discussion also takes a long view on income investments. There's a big section on bonds versus bond funds, and even on cash alternatives like treasury bills in comparison to certificates of deposit.
Yeah, it's quite comprehensive. The inclusion of bond funds is particularly relevant for investors who may not have enough capital to diversify by buying individual bonds. This approach, offered by major firms like Vanguard or Fidelity, makes diversification accessible even with
And that's
smaller
a game
sums.
changer. And then we get into more nuanced areas like mortgage securities, annuities, and even strategies involving convertible issues. Although those are typically beyond the defensive investor's core strategies, they are presented as options for special situations or for increasing income yield.
Correct. They serve to illustrate the breadth of the investment landscape, but the key takeaway for the defensive investor is simplicity and safety. With so many choices, it's about narrowing down to those instruments that align with one's risk tolerance.
Absolutely right. Lastly, there's that rather provocative question raised. Can you be brave or will you cave? It's almost like a challenge to the investor to stick to their strategy even in turbulent times.
Yeah, that's a strong message. For most people, fear can be as damaging as market risk. The philosophy here is to maintain a level-headed approach, even when the market starts to stutter or plunge.
That's crucial.
It's a call to be rational, to create a plan, and then to follow it even when emotions run high.
So, to wrap up, the defensive portfolio strategy really hinges on your personal risk tolerance, embracing a balanced mix of bonds and stocks, disciplined rebalancing, and a deep understanding that market behavior is unpredictable, but your self-control is the strongest asset.
Exactly. And while it might appear oversimplified, this method offers a steady framework. It encourages investors to use informed judgment and consistent evaluation of their unique situation to guide their asset allocation over time.
Right on. It's a reminder that investing isn't solely about chasing high returns if you're not built for volatility, but rather about crafting a resilient strategy that supports your long-term financial well-being.
Absolutely. Consistency, discipline, and a clear head are your best allies in navigating these financial challenges.
Well, that captures the essence of a defensive investment strategy. A perfect blend of strategy, emotional control, and calculated risk. Truly a recipe for steady, long-term success.
And that's the heart of it. Thanks for the insightful discussion. Welcome to the show. Today we're diving into the world of defensive investing and common stocks, where the focus is on staying safe while still capturing enough upside, sort of like having a balanced diet for your portfolio.
Yep, I'm excited. So the basic idea is that common stocks, despite their reputation for speculation, can actually serve a defensive investor well, if handled correctly, right?
Exactly. It's all about the merits common stocks bring. Historically, they've provided protection against inflation and delivered higher returns over time, thanks to dividend income and reinvested undistributed profits, even though there's always a risk of overpaying.
That caution about overpaying for stocks is really key. The content stresses that buying at too high a price, say like what happened in 1929, can wipe out those benefits.
Yeah, it's like, if you buy groceries at the highest prices day after day, you're not really making a wise choice, are you?
Absolutely.
Similarly, if you overpay for a stock, any long-term dividends and growth get undercut by the initial high entry cost.
I really liked how they laid out specific selection rules for defensive investors, like keeping diversification in check, focusing on large, prominent, conservatively financed companies, and insisting on a long history of uninterrupted dividend payments.
Right. They suggest having anywhere from 10 to 30 different issues. Too many stocks lead to over-diversification, while too few increase risk exposure. And that requirement of continuous dividend payments, starting from, say, the 1950s, serves as a long-term quality filter.
And then there's the point about pricing relative to earnings, right? They set a limit of 25 times average earnings over 7 years and 20 times for the last year's earnings. A strict standard that essentially filters out the popular but overpriced growth stocks.
Yes, exactly. It's a pretty drastic exclusion, essentially sidelining growth stocks. And while growth stocks like IBM or Texas Instruments once delivered phenomenal rewards, the volatility and high multipliers can lead to dramatic drops, as highlighted by those historical examples.
Totally. So, would you say that for a defensive investor it's a trade-off? You sustain lower potential gains in exchange for lower risk?
Precisely, it's a trade-off. Defensive investors prioritize steady returns and preserving capital. And even if stocks, humorously, are seen as the lesser of two evils compared to an all-bond portfolio, they still require some exposure to capture growth, especially when bond yields are so low.
Yeah. Speaking of bonds, I recall the content pointing out that bonds don't offer any inflation protection at all. So common stocks, even with their fluctuations, protect against the erosion of dollar value better. Isn't that a pretty compelling argument?
It truly is. Inflation eats away at bond yields, while stocks, with their reinvestment of profits and dividend growth, naturally hedge against inflation. It's like comparing a rusted old bike to a new adaptive car.
Right. Now let's talk about the investor's personal situation. The guidelines differentiate between, say, a widow with a hefty sum, a mid-career doctor, and a young man just starting out. Each has distinct challenges from cash flow to risk tolerance.
Absolutely. Take the widow, for instance. She needs to live off her investments and therefore her conservative, almost balanced approach between good bonds and quality common stocks. And for the young guy, a more straightforward, automated approach might be preferable.
It makes sense. The risk profile isn't just about money on paper, but also about one's ability to absorb market fluctuations emotionally and financially.
Right on. And that's where the discussion on dollar cost averaging really shines. The idea is to invest a fixed dollar amount at regular intervals, so you naturally buy more when prices are low and less when they're high. It takes the guesswork out of market timing, sort of like setting it on autopilot.
I love the analogy of autopilot. It reminds me of index funds being described as the ultimate defensive play, minimal hassle yet effective diversification.
Exactly. Index funds offer a passive or Rip Van Winkle approach, where you're invested almost completely without fuss. It's a strategy that's particularly effective when you're not in the business of predicting market swings.
But one thing that I want to challenge a bit here, some might argue that putting everything on autopilot can lead to complacency. Do you think there is a risk of ignoring significant shifts in the market?
That's a fair point. While autopilot is fantastic for disciplined long-term investing, it should not be mistaken for complete inattention. Even defensive investors need to periodically, double-check their portfolio to ensure it still meets those conservative criteria. It's about periodic review, not daily micromanagement.
Got it. So, while the system minimizes emotional reactions to market swings, it doesn't completely remove the need for oversight.
Exactly. Now, switching gears a bit, the content also talks about the pitfalls of buy what you know. It warns that just because you're familiar with a company doesn't mean you've done the necessary homework on its financial strength or valuation. Home bias can be dangerous if unchecked.
Yeah, take the example where employees overly invest in their own company's stock. That kind of familiarity can lead to overconfidence and eventually painful losses, as seen in the high-profile collapses of companies like Enron.
Exactly. There's a caution against the pitfall of, I know this brand, therefore it's a good stock. One must analyze the financial statements and valuation.
Absolutely.
It's not enough to just know the product. You need to understand the numbers behind it.
And then there's the novel idea of direct stock purchase plans through online brokerages. It's fascinating how technology has democratized investing these days.
Yes, the advent of micro-investing online lets even someone with a small monthly budget invest in a diversified portfolio. You can start with as little as a few dollars per transaction on platforms like ShareBuilder. Even though there's a transaction fee that can seem high relative to a small investment, it's a gateway for the beginner investor.
I also noticed that while online platforms are super convenient, the text warns about the potential for tax headaches if you're buying small increments over many years without proper record keeping.
Right. Managing administrative details is crucial. Even if you're on autopilot, you have to keep track of everything. Otherwise, the benefits could be overshadowed by unexpected complications during tax time.
Yeah, and speaking of record keeping, it's interesting to note the advice about not over-trading. If you find yourself trading more than a couple of times a year, it might be time to reassess your strategy.
Exactly. Defensive investing is all about discipline. The aim is to maintain a portfolio that doesn't require constant tweaking. If you're making too many moves, you're essentially turning a defensive strategy into
Absolutely.
speculative trading.
Then there's the part about the investor's temperament and financial education, influencing the type of securities purchased. It's not just about the numbers, it's about how well you know yourself as an investor.
Totally. The piece makes the point that, for example, a doctor who lacks time for investment research might be better off with a defensive, nearly hands-off portfolio.
Right.
Your personal circumstances and temperament really dictate the strategy.
And that really drives home the idea that investing isn't one size fits all. Whether you have $200,000 like the widow in the example, or just $1,000 a year like the young man, the approach should be tailored to your situation, finances, and your emotional resilience to market downturns.
Absolutely. Then we come to the punchline of it all, the concept of I don't know and I don't care. It's liberating. It means you recognize that you can't predict every market twist, so instead of overanalyzing, you just stick to your plan and let the market run its course.
Yeah, that's such a refreshing perspective. In a world where everyone is trying to beat the market with daily predictions, embracing uncertainty with a steady approach is almost revolutionary.
Exactly. It's like, ironically, delegating control. By accepting that you don't have to predict the future, you free up your energy to simply ensure that your investments remain balanced and in line with your long-term goals.
So, to wrap up, the defensive approach to common stocks really comes down to disciplined, research-based selection, avoiding the lure of overvalued growth stocks, embracing dollar-cost averaging, and aligning your investments with your personal financial situation and temperament.
Right on. It's about ensuring that even in volatile times, you have a portfolio that's built to weather the storms, protecting against inflation and tapping into steady growth over time.
Absolutely. What a well-rounded approach. I love that it blends practical guidelines with a realistic view of market behavior. And honestly, isn't that the hallmark of smart investing?
Totally. And if you stick to these principles, diversification, mindful selection, periodic review, and a healthy dose of humility, you're well on your way to managing risk without sacrificing future growth.
Yep. Thanks for breaking it down. I feel like defensive investing has never been more accessible and understandable.
Thanks for the chat. Remember, the key is to invest smartly, not speculatively, and let your plan do the heavy lifting. See you next time. Let's kick things off with some thoughts on portfolio policy for the enterprising investor. You know, the negative approach that tells us what to avoid rather than chasing every hot yield out there.
Absolutely. It's all about being ultra discerning with your investments. Sort of like saying, don't go after anything that isn't high grade, right?
Exactly. The aggressive investor, despite having the freedom to branch out a little, should always start from a very solid base. Usually a mix of high-grade bonds and common stocks purchased at reasonable prices. It's like building a house on solid rock before adding any risky extensions.
And that base ensures you're not tempted to venture into dangerous territory without good reason, correct?
Yes, that's key. Graham essentially advises us to draw up boundaries, a negative checklist. He warns against second-grade bonds and inferior types of preferred stocks unless we can snag them at a hefty discount, say 30% under par on high coupon issues, for example.
That makes sense. But isn't there an argument that sometimes chasing a higher yield, even on second-grade bonds, might be worthwhile if you can properly price in the risk?
Well, sure, one might argue that.
Yep.
But the point here is that you should only jump in if the discount is compelling enough to offset any potential loss of principal. It's like you wouldn't buy a used car with a rotten engine just because the price looks tempting.
Right, and if I recall correctly, Graham even pointed out examples like some railroad income bonds that despite their higher yields, ended up having dramatic principal losses when markets turned sour.
Exactly. Those bonds could be selling at, say, around 50 cents on the dollar, even though they had old-style coupon rates. The catch was that their earnings weren't strong enough to cover the interest sufficiently.
Speaking of risky yields, what about what we now call junk bonds? Graham was pretty clear on that front too, wasn't he?
Very much so. Graham gives junk bonds a brisk thumbs down. In his day, it was nearly impossible for an individual to diversify away the default risk in such bonds. Even though today we have mutual funds that can spread that risk around, his general caution remains relevant.
So, while modern diversification helps, the underlying principle of not paying too high a price for extra yield still stands strong, right?
Exactly. If you buy a high-yield preferred stock for just a tiny extra yield without a significant discount, you're risking a substantial part of your principal. It's a classic case of not getting what you pay for and paying more than you should if things go bad.
And then there's the whole realm of foreign government bonds. They might look attractive yield-wise, but there's that nagging risk related to enforcement of claims, isn't there?
Yes, and that's a major red flag. Even if bonds of, say, Australia or Norway might seem safe on the surface, history shows that trouble like Cuba's bonds or those erratic bonds from, emerging markets can be brutal. When things go south, you're left with nothing enforceable.
Exactly. That definitely underscores the need for caution. Now, shifting gears a bit, what about new issues in general? There's a lot in the material on that too.
Right. New issues are a whole different beast, mostly because of their aggressive salesmanship. Graham
sales
noted
pitch
that
overload.
almost every new issue, be it bonds or common stock flotations, comes under very favorable conditions for the issuer rather than the buyer.
It's like, why would someone jump at a new issue if the conditions are rigged against you? Often you get swept up in the hype, only to see prices plummet later.
Exactly. And that's where the negative approach really hits home, especially with new common stock offerings. They tend to get overpriced in a bull market, and once the market cools, you end up with steep losses.
That reminds me a lot of the VA Linux saga, where the IPO was hyped up to astronomical levels only to come crashing down hard.
Yes, VA Linux is a perfect example. It's like paying nearly $13 billion for a business that wasn't even making profits. It was practically a money loser.
Yeah, it's absurd. And it just highlights the danger of letting popular enthusiasm dictate investment choices instead of sticking to solid fundamentals.
Absolutely. And beyond the IPO debacles, there's another major pitfall: trading too frequently. The material makes it clear that the more you trade, the more you lose, not to mention the tax implications.
Right. Trading isn't free. You get hit with so-called market impact costs, where an extra bid can cost you money, and it's those invisible fees that gradually chip away at your returns. Even a small price bump, like 5 cents per share, can add up quickly.
Exactly. Not to mention turning long-term capital gains, which might be taxed at around 20%, into ordinary income taxed as high as 38.6%. It's a double whammy against frequent trading.
Barber and Odine's research really drove that point home. The most active traders ended up underperforming the market by a significant margin after accounting for these costs.
Yes, the numbers don't lie. And it's not just about the brokerage fees. It's about the lost opportunity to let your money compound over time. It's like you're literally handing money over to your broker instead of letting your investment grow.
I do wonder, though. Some might argue that a bit of active trading can yield higher returns if you truly know what you're doing. But isn't that more the exception than the rule?
That's a fair challenge. However, the evidence overwhelmingly shows that even professional traders struggle to outpace a patient. Long-term strategy once all these hidden costs come into play.
Yeah, that's the truth.
Overtrading tends to be self-destructive.
So then, the card to play for the intelligent investor is to be disciplined, stick with high-quality investments, and steer clear of speculative shortcuts, like chasing IPO darling stories or overly hyped new issues.
Exactly. It's the negative checklist approach. What shouldn't you do? Do not overpay for low-quality securities. Do not mix in high-yield junk unless you can buy at bargain prices. And definitely don't let salesmanship seduce you into a bad
Sure.
deal.
And that negative approach seems timeless. Whether it's the days of convertible bonds and deep discounts or the modern mutual funds focusing on junk bonds, the principle remains. Never sacrifice the principle for a meager yield bump.
Right. And even in today's environment, though diversification techniques have improved, like those junk bond funds where you hold dozens of exposures, the risk remains that fees and market downturns can still eat into returns.
It's almost like while the instruments might change, the underlying economic truth stays the same. You don't want to be that investor who chases the next miracle only to have it crash harder than expected.
Precisely. And if I may add an analogy, investing in a security solely for its attractive yield is like marrying someone only for their looks rather than their character. When the tough times hit, that superficial appeal can vanish,
Yeah, that really sums it
leaving
up.
you with a broken heart and a lighter wallet.
And we can't forget about the extreme example with WorldCom bonds. They were once offering fat yields, but behind that facade was a company over-leveraging itself until it ultimately imploded.
Exactly. No yield amount could ever justify the risk of an explosion like that. WorldCom's debacle reminds every investor that if the fundamental earnings can't support the cost, you're just digging yourself into a debt pit.
Which ties back to the overarching strategy. Do your homework. Be skeptical of high yields without solid underlying support. And remember that aggressive trading strategies can backfire, leaving you with far worse outcomes than a patient, conservative approach.
Absolutely. The ultimate wisdom here is that investing is a marathon, not a sprint. Aggressive investors might be tempted by quick gains through day trading or hot IPOs, but the evidence is consistent. Holding steady in high-quality assets
spot on.
wins in the long run.
And on that note, it's pretty clear that while market temptations are alluring, sticking to a well-thought-out negative checklist helps avoid those costly missteps. Wouldn't you agree?
Definitely. Our discussion reinforces the idea that every extra percentage point in yield must be weighed against the risk of permanent capital loss, like buying something at 100 when you know the true value might drop to 70 later.
It's a lesson that transcends decades, whether discussing second-grade bonds, foreign government issues, or even the siren call of IPOs.
Exactly. It's all about discipline, patience, and most importantly, a willingness to say no when the numbers just don't add up.
Right, absolutely. That's a message that really should resonate with anyone serious about investing. Not every hot tip is a ticket to wealth. Sometimes doing nothing is the smartest move you can make.
Well put. By resisting the urge to trade frequently or dive into overhyped new issues, you keep your portfolio robust and shielded from the many hidden costs of speculation.
And that brings us to the end of today's deep dive. It's amazing how timeless these lessons are, from the pitfalls of junk bonds and volatile IPOs to the insidious drag of trading costs.
Exactly. The intelligent investor's path isn't paved with flashy quick gains. It's built on steady, cautious steps that protect your principal and let that compound interest work its magic over the
indeed.
long haul.
Thanks for unpacking these insights. It's a reminder that in the world of investing, sometimes the best move is to simply stand still and let your fundamentals do the work.
Absolutely. Stick to high-quality choices. Be wary of the tempting shortcuts and always weigh the extra yield against the potential risk. That's the way to ensure your portfolio can weather any storm.
True that. Here's to smart, patient, and disciplined investing that outlives the fleeting hype. Thanks for such an engaging conversation. It really makes you think twice before chasing the next big, risky trend.
Thanks. And remember, investing isn't about quick wins. It's about building a foundation that lasts. Until next time, keep your analyses sharp and your strategies sound.
Couldn't agree more. Cheers to keeping our portfolios safe and our minds clear.
Welcome to the podcast. Today we're diving deep into investment policy for the enterprising investor. We're talking about a positive side of portfolio policy that really challenges conventional wisdom.
I'm excited to get into this. So where do we start? Is it with the different kinds of bonds or maybe common stocks?
Absolutely. One of the major themes is that the enterprising investor can branch out into unique bond opportunities like tax-free new housing authority bonds guaranteed by the US government, high-yield new community bonds, and even tax-free industrial bonds, kind of a menu of specialized opportunities that aren't available
Yep.
to the defensive investor.
Right. And these suggestions, they really underpin the idea that if you have the time and research skill, you can really beat average returns through smart selection of these less common instruments.
Exactly. Then switching gears to common stocks, the text lays out 4 basic operations. We've got buying low and selling high, choosing growth stocks, snagging bargain issues, and even looking at what they term special situations.
And don't forget the part about timing, specifically how trying to perfectly time market highs and lows is almost an exercise in futility. It's highlighted as a mathematically uncertain strategy.
Yes, that's a huge point. Even when you study historical patterns, like in the 20-year market charts, the idea of timing the market exactly just doesn't hold up mathematically. It takes what they describe as a special talent, almost like a feel, rather than solid analytical judgment, which is precisely why it's not
Right.
recommended for most investors.
So instead, the approach is to manage your overall portfolio within a set range, like holding anywhere from 25% to 75% in common stocks, depending on your market conviction, isn't it?
Exactly. That flexibility allows enterprising investors to adjust based on market conditions, and it's separate from the idea of timing peaks and valleys perfectly. But what really caught my attention is the discussion on growth stocks.
Yes, growth stocks are fascinating because while investors naturally want to pick companies that have outperformed averages in the past, you can easily overpay because their future prospects are already baked into current prices.
Right, it's like you might be tempted to think picking the top 15 or 20 from a broker's list guarantees success. But because good records translate to high prices, even a correct positive judgment might leave you with subpar gains.
And also, when the company expands rapidly, the next few steps become exponentially more difficult, right? They simply can't keep up with explosive growth forever.
Absolutely. That's why the text really emphasizes caution in the growth stock arena. In fact, when comparing growth funds over extended periods, even though the average gain might beat market indices slightly, they don't deliver outstanding rewards relative to the overall investment in common stocks.
Yep, that's compelling. Now, shifting to the topic of undervalued or bargain issues, the material introduces a solid methodology. How do you see that playing in the enterprising investor's context?
Well, here the idea is to define a bargain rigorously as an issue that should be worth at least 50% more than its price based on underlying value. This value can be determined by estimating future earnings or by looking at the business's net current assets.
And what's interesting is that the text cites examples like General Motors in 1941, or even more detailed studies of stocks bought at less than their net working capital. It's a clear signal that when the market creates these undervaluation situations, often due to neglect, temporary problems, or swings in market mood, there's an opportunity there.
Correct. Investors who are prepared with the time and analytical skill can, in these cases, pick up shares at what's essentially a discount, often far below their fair business value.
But don't you think it's a bit of a risky proposition if the market never recognizes that true value? I mean, there's always the risk that the undervaluation persists far longer than expected.
That's a respectful challenge, and it's exactly why the emphasis is on diversification when picking such bargains. The text lays out multiple sources for undervaluation: temporary disappointing results, a period of neglect, or even failures in the market's recognition of a company's true earnings. The message is to not put all your eggs in one basket, but to pick a diversified portfolio of these strong, undervalued companies.
Speaking of eggs in baskets, the commentary on concentration versus diversification is really striking. The notion that while big fortunes are sometimes made by concentrating on a single well-understood stock, most investors are likely to experience dramatic failures if they do so indiscriminately.
Exactly. It quotes Andrew Carnegie in a memorable way: "Put all your eggs in one basket and then watch that basket," underscoring that concentrated investments are double-edged swords.
Right, absolutely. And then there are those special situations or workouts that come from corporate mergers, arbitrage on bonds, and even legal issues, which create temporary distortions in price. While they used to be more common, the landscape has changed.
Yes, special situations are a niche area that require a deep understanding and a willingness to take on the complexities of arbitrage deals. These opportunities, like bonds in railroad bankruptcies or public utility breakups, are not for casual investors. And then there's a discussion on the implications of these strategies. Essentially, the investor must choose rather starkly between the defensive and the enterprising role. There's no middle ground. You're either committed to a business-like approach with deep analytical research, or you're going to settle for the safer, more typical returns.
That binary either-or classification is really interesting because it makes one think hard about one's investment temperament. It's like, how much time and effort are you prepared to devote? Because if you're not going all in, you might end up compromising on returns.
Exactly. They caution against the half-businessman syndrome, expecting half the returns of a dedicated, fully engaged investor.
Right. One area I find particularly compelling is the idea of selecting unpopular large companies.
Yes. The logic is that when market sentiment turns away from large companies due to minor, temporary setbacks, their prices can become undervalued. And since these companies have the strength to bounce back, it creates a conservative yet promising opportunity. It's like buying quality on sale.
And the statistics back it up, right? Studies of the Dow Jones Industrial Average over decades show that low multiplier, unpopular stocks have, on average, generated better returns than their high multiplier popular counterparts.
Precisely. For instance, the Drexel test illustrated that over 34 one-year holding periods since 1937, the low multiplier stocks significantly outperformed. It's a quantitative argument that if you adhere to these principles, the odds are tilted in your favor.
Yeah, that's a strong point. Then there's the discussion on market timing, which really debunks the notion that one can reliably exit before the worst days or enter right at the bottom. The studies comparing market timing to simply staying invested in index funds, those numbers are staggering.
Absolutely. One study mentioned that if you had managed to get out before the worst trading days, your $1 would have ballooned astronomically. But of course, knowing those days in advance is impossible. It really underlines that trying to pick the perfect moment is both impractical and risky.
And then shifting to the global picture, the text cautions against overconcentration in domestic markets. It even gives a thought experiment about the Japanese market in 1989. The lesson is to diversify internationally to hedge against domestic downturns.
Right. Yes, that experiment shows that even if your home market is booming, putting all your money there is a gamble. Diversification into foreign stocks can protect you from unforeseen local declines. Although it's not mandatory, it's a prudent measure.
That makes a lot of sense. Throughout the text, there's a recurring theme of requiring objective tests and a difference of strategy from the mainstream. It's not just about finding undervalued stocks, but using sound business criteria to evaluate them.
Exactly. The twofold merit, meeting rational underlying tests and being different from the common speculative approach, is crucial. If you're doing what everyone else is doing, you're just riding the herd. This is why, for instance, buying stocks only when they are trading for less than 2/3 of their appraisal value is recommended.
Now, I'd like to challenge one aspect a bit. The text seems to suggest that secondary stocks are almost universally undervalued. But isn't there a risk that these companies remain undervalued due to structural or management issues that aren't easily corrected?
That's a fair challenge. Indeed. While many secondary companies are undervalued simply for being out of favor, there are cases where persistent poor performance justifies their low price. The recommendation is for enterprising investors to use additional analyses, both quantitative tests like price earnings and net working capital comparisons, and qualitative factors to weed out those that won't recover. It's not a blind buy-in.
So the bottom line is that while there are areas of opportunity, be it special bonds, growth stocks when priced reasonably, bargains identified by solid fundamental analysis, or special situations, The enterprising investor must be both aggressive and cautious, basically treating investments as a business.
Exactly. And the key takeaway is that you need to choose your role decisively. If you're not ready to view investments as true enterprises, then you might be better off with a defensive strategy. But if you're willing to do the homework and bear some extra risk, there are multiple well-proven strategies that could lead to superior results.
Yeah, that's the essence. Wow, what a journey through these ideas. It really drives home the point that investment strategies aren't one size fits all. They require a keen sense of both the market and one's personal investment style.
Definitely. And while the mathematics of market timing and the challenges of growth companies caution us against over-optimism, the deep dive into undervalued and special situations offers a more nuanced, strategic view on building long-term wealth.
Thanks for breaking down these concepts so thoroughly. It's been a real deep dive into the science and art behind sound, enterprising investment strategies.
My pleasure. Remember, investors, whether you're managing a large portfolio or just starting out, it's all about matching your approach to your skills and temperament. Until next time, keep your focus and your strategies sharp. Welcome to the podcast, where we dive into market dynamics and investor psychology. Today's discussion really spans the spectrum, from how fluctuations in stocks and bonds affect your portfolio to why Mr. Market, the personification of market moods, should be treated as your servant, not your master.
Yep, absolutely. The input is rich, covering everything from investment strategies like timing versus pricing to the psychological traps that cause investors to buy high and sell low. So where do we begin with these ideas?
Let's start with the most basic idea: investor versus speculator. The text stresses that the intelligent investor is concerned with buying suitable securities at reasonable prices, not trying to predict the market's every whim. Essentially, it's about holding investments long-term while not getting seduced by market noise.
Right, and it warns that if you try to time the market by forecasting short-term moves, as tempting as it might be, you're likely heading into speculation territory, which could lead to losses. It's interesting, though, how the chapter explains that timing only makes sense if it coincides with buying stocks at a price below their intrinsic value.
Yeah, exactly. It kind of highlights that the market fluctuations, those ups and downs, are only opportunities if you can buy at a bargain and sell when the price is high enough to offset any losses in dividend income, understood in percentage terms. It's like knowing when to savor a good bargain at a store rather than buying everything on a whim.
And speaking of bargains, the A&P example really drives home how the market can get wildly mispriced relative to the real value of the business. A&P was once trading at a fraction of its actual asset value, and then the market swing reversed things dramatically. It shows that prices can be detached from fundamentals for a time. Right,
and that example illustrates two morals. First, the market can be irrational, often giving you what seems like a once-in-a-lifetime bargain. And second, businesses change over time. So what appears to be a bargain at one point might not be one later on if the company's earnings prospects change.
Absolutely. But here's something that puzzles me a bit. You see, the text also goes into formula plans for investing. It seems as if these mechanical methods, like dollar cost averaging or a central value method, initially show great historical results. But then, when everyone starts using them, their effectiveness declines. What do you think about that?
Oh, that's a really interesting point. It's like the more popular a trading formula becomes, the more its edge erodes because the market adapts. The text even draws a parallel with the Dow theory. Its performance was stellar initially, then it basically became self-defeating as more people followed it.
Yeah, exactly. I see what you're saying. So while the formula approach can work historically as an analytical exercise, in practice, if too many investors jump on the bandwagon, then the formula itself loses any special advantage. But isn't it also true that these methods give some comfort to the investor, a kind of structured discipline to avoid impulsive decisions?
Totally, and that mechanical element helps keep emotions at bay. The text emphasizes that by having a pre-decided formula, you free yourself from the daily noise of the market, which is exactly what a prudent investor should do. It's almost like having a set recipe that ensures you stick to your investment plan, no matter what Mr. Market is shouting out.
Speaking of Mr. Market, his image is one of the most vivid parts of the input. The idea is that he's manic one day and depressed the next. And rather than get swept up in his mood swings, you need to do your own homework and decide what's right for you.
Right. Mr. Market is that personification of market sentiment who offers you daily prices. The clever insight is that his fluctuating offers are opportunities. You can sell when his offer is too high if you think it's unjustified, or buy when his low offer gives you a margin of safety. It underscores that you should never let his mood drive your decisions, but rather use his offers as, indicators to stick to your own strategic plan.
That's a refreshing perspective. It really contrasts with the behavior of many mutual fund managers who inadvertently become slaves to market sentiment. They have to buy high and sell low due to the massive flows of funds and benchmark pressures. I mean, isn't it a bit ironic that professionals end up falling for the same traps as individual investors?
Indeed, and that's where the text respectfully challenges the conventional wisdom from Wall Street. The so-called professionals are forced into a cycle that sometimes makes it almost impossible to beat market averages because they end up mimicking the herd. There's a notion that by controlling your own behavior, sticking to a plan, trading infrequently, and keeping costs low, you can actually outperform the instinct-driven decisions of the pros.
Right. It also talks about the psychological aspect of investing. There was a section about brain activity, how dopamine is released when a stock goes up a few times in a row, making you excited, and on the flip side, how losses trigger your fear centers. That explains, in part, why people are so prone to making irrational decisions at market highs and lows.
Yes, exactly. The research from Kahneman and Tversky really illustrates that our brains are wired to pursue patterns even when they're random. That inherent bias plays into why we might hold on too long during a bull market or panic during a downturn, locking in unnecessary losses. It's a biological trap that every investor, regardless of intelligence, has to fight against.
Absolutely. So, if the brain is inherently wired to seek trends and get excited by short-term gains, then the long-term investor's strategy should be all about consistency, dollar-cost averaging, rebalancing, and ignoring daily noise. But let me challenge one point here. Isn't it sometimes useful to be aware of market conditions to, say, use tax loss harvesting strategies or to rebalance when prices are extreme?
That's a fair point. The text does mention that there are exceptions, like selling into a bear market for tax reasons. For instance, if you have a paper loss, you might actually lock in the loss to offset gains and then repurchase after an appropriate waiting period. So yes, there's a nuance. Being aware of market conditions can be beneficial if you let it serve a disciplined strategy rather than impulsive decision-making.
This brings us to another interesting point about market forecasting. The input is pretty clear. Predicting market movements is almost a fool's errand. The general public, and even many professionals, simply can't consistently forecast better than the group as a whole. It's almost like trying to outsmart a system that's self-correcting.
Right, and the discussion on the Dow theory is a great example of that. Initially, it worked brilliantly. Think about how it signaled the 1929 crash and later saved some investors from deep losses. But as it became widely used and publicized, its predictive power diminished. It really shows the paradox that success in forecasting might be its own undoing once everyone starts acting on it.
True, exactly. On that note, another major theme is the concept of buy low, sell high. The input makes it very clear. It's not practical to wait for the perfect bear market low or bull market high because doing so can mean missing out on dividends or worse, missing the market's long-term upward trend. It suggests that a balanced approach, essentially buying regularly unless prices are way too high by value standards, might be the wisest course.
Yeah, that's the crux of it. Rather than trying to time the market perfectly, you use wide fluctuations as opportunities. If stocks fall sharply, that's your cue to buy, but you shouldn't get paralyzed waiting for the absolute bottom. Similarly, selling only when stocks have soared excessively might result in selling too early, sacrificing the benefits of continued growth. It's a delicate balance that relies more on discipline than on crystal ball predictions.
Absolutely. And then we come to the bond market discussion, which is equally nuanced. Even high-grade bonds can have wide price swings if held for the long term due to interest rate changes. It's all about whether you want to lock in stability or chase slightly higher yields with some price variability. The idea of having bonds with a variable component tied to current rates is quite interesting. It could potentially smooth out those fluctuations. Yeah, that makes sense.
Exactly. It's all a trade-off. Traditional bonds offer stability in principal value, but may have low yields, whereas opting for higher yields brings risk of price variation. The text even points out that banks calculate bond values on an amortized cost basis, effectively ignoring market price swings, which is a strategy individual investors might consider adopting
Right.
to avoid emotional distress over day-to-day fluctuations.
Then there's this fascinating final thought about how your investment's true value shouldn't be judged by daily market noise. Instead, it should be based on intrinsic value, the company's operating performance, and your long-term financial goals. That's a pretty solid rebuttal to the obsession many have with daily price changes, wouldn't you say?
Absolutely. The idea is to see the market's daily ups and downs as just noise, like checking your bank balance every minute. It can lead to emotional decisions and ultimately ruin the long-term strategy. Investors should focus on their dividends, earnings reports, and overall business performance rather than on every little blip that Mr. Market sends their way.
Exactly. There's also that striking commentary about behavioral finance. Our innate desire to see patterns, even where none exist, means we're wired into making irrational trades. The insight that the pain from losses is psychologically more potent than the pleasure from gains really explains why investors panic during downturns. Yeah, and it's something we all have to work on.
Right. It's a call to be mindful of our own neurology. By recognizing that our brains are set up in a way that almost compels us to follow market trends, we can step back and set up systems, like an investment contract or an automatic investment plan, that keep us from being swayed by fleeting emotions. It's like putting on a seatbelt before you drive into a storm.
Exactly. And finally, the input reminds us that at the end of the day, investing isn't a sport of beating others out there. It's about meeting your own financial needs over a long period. Whether you're in a bull market or a bear market, the goal is to have a structured plan that aligns with your personal goals, not to be caught up in the hype-chasing fleeting gains.
Yeah, that's the real wisdom here. Instead of obsessing over outperforming the market, you focus on controlling what you can, your own behavior, your investment costs, and your asset allocation. As the text puts it perfectly, don't let the market's mood swings dictate your emotional state or your decisions.
Right on. I love that final analogy about Mr. Market giving you lemons and making lemonade. It's a reminder that even in the chaos, there are opportunities if you stick to your plan. And honestly, in a world of rapidly shifting market sentiments, having that inner discipline is your best asset.
Absolutely. It's about being the master of your investment strategy, not letting external noise and impulsive sentiment override thoughtful analysis. In a way, the entire chapter is a lesson in self-control, intellectual rigor, and humility before the market's inherent unpredictability.
As we wrap up, the key takeaway here is that the intelligent investor must maintain a balanced perspective. He should be prepared for volatility, be it in stocks or bonds, while focusing on fundamentals and not getting misled by short-term fluctuations. And ultimately, it's about staying true to your long-term plan, regardless of Mr. Market's craziness.
Exactly. It reminds us that while the market may be mostly accurate in pricing, thanks to millions of buyers and sellers, there are moments when it becomes wildly irrational. And in those moments, you need to use your own judgment, stay disciplined, and sometimes even shrug off the daily noise to really capture the long-term gains.
This conversation has been really enlightening. It's a detailed exploration of the interplay between market forces and human psychology, a melody of financial principles that reinforces why, in investing, being in control of your own decisions is everything.
Indeed, it's all about recognizing that ultimately, never buying after a substantial rise or selling right after a drop is key. Following sound investment contracts and a disciplined strategy lets you ignore day-to-day moods and focus on what truly matters,
Right.
building wealth over time.
All right, thanks for the chat today. It's been a deep dive into the nuances of market fluctuations and investor behavior. I think listeners will find this perspective both grounding and, well, refreshing in these volatile times.
Absolutely. And remember, you're the one steering your own investment ship. Don't let Mr. Market's mood swings hijack your strategy. Stay disciplined, stay informed, and keep your sights on the long-term
Cheers to that.
horizon.
Until next time, keep calm and invest smartly. Thanks for joining me in this discussion.
Welcome to today's discussion on investment funds, specifically the in-depth look into mutual funds, closed-end funds, and those notorious performance funds. It's fascinating how defensive investors have so many options, right?
Absolutely. When you consider the variety, from open-end mutual funds with redeemable shares to closed-end companies whose shares float in the market, it's quite the maze for the average investor.
Right, it's like a maze with many twisty turns. The text explains that mutual funds, which are actively marketed by salesmen, tend to carry a selling charge while closed-end funds trade at market prices and often at a discount.
Yeah, exactly. And speaking of discounts, the idea that you might buy closed-end shares at, say, a 10 to 15% discount compared to the net asset value is really compelling. Do you think that's a significant advantage?
Oh, for sure. I mean, the arithmetic laid out shows that the return on closed-end funds can be considerably higher if the discount stays within a certain range. Even if the discount widens slightly over time, it's still tough to beat the open-end share scenario that includes that premium.
Right. It kind of challenges the traditional salesman argument, where they urge you to buy open-end funds because you're guaranteed to redeem at full asset value. That guarantee sometimes comes with a cost you might not want to pay.
Absolutely. Think of it this way. It's like paying extra at a restaurant for the service, even though your meal quality is about the same as if you dined at a less expensive local spot. And yeah, the numbers in the text really back up that notion.
And then there's the whole piece about performance funds. The chapter really dives into how managers chase those big short-term gains, like that Manhattan Fund example, which had spectacular gains one year and then tumbling losses soon after.
Yes, that's a classic cautionary tale. It seems that many of these performance funds are driven by youthful energy, like managers in their 30s and 40s who haven't experienced many market downturns. They take big risks, which can lead to huge gains if the market's on their side, but then, well, the risks materialize and investors get hurt.
I find it intriguing how the text contrasts the average investor's behavior compared to these managers, like the ordinary investor might be better off simply sticking with diversified funds rather than jumping on the hype train of so-called performance funds.
Right, because the text points out that over time, the average individual who invests in mutual funds tends to do better than those who try to pick stocks directly. The mutual funds promote good saving habits, even if, on paper, their performance can seem similar to the broader market.
Yeah, it's almost like the funds serve as a safety net against making speculative mistakes. And yet it's ironic that these funds often underperform because of their high expenses and the constant churn from asset elephantiasis.
Exactly. You know, the asset elephantiasis part, where a fund grows so massive that its returns get dragged down by higher costs and trading difficulties, is like trying to steer a cruise ship through a narrow canal. It's unwieldy.
Exactly. Couldn't agree more. And there's that part on index funds. The text really hammers home how, over the long, say 20 years, an index fund with its rock bottom expenses can dramatically outperform the average actively managed fund.
Right, it's like the tortoise and the hare. Index funds with minimal fees, 0.2% operating expenses, and 0.1% trading costs will almost certainly accumulate more wealth over time than a fund with 1.5% or 2% in costs.
Yep, But don't you think the allure of a hot fund is strong despite that? I mean, there's always that temptation to boast about having the top performing fund, even if it's not actually beating the market in the long term.
Oh, absolutely. It's so human to want to feel in control. The commentary even jokes about the psychology behind it, with overconfidence fueling those who believe they can outsmart the market even when data suggests otherwise.
Right. That part where the text cites surveys about investors' false perceptions, literally thinking they're in the top 1% income bracket, or that their portfolios beat the market, really underscores this point.
Yes, it does. And it reminds us that overconfidence isn't just harmless bravado. It can lead to serious financial mistakes. People end up buying high and selling low, which is the worst case scenario in investing.
And then there's the discussion about fees. I found it striking that funds with higher fees tend to produce lower net returns over a long period. It's a bit counterintuitive to the common notion that you get what you pay for.
Precisely. Pricing in this industry is often deceptive. The research shows that high returns, which might on the surface justify higher fees, tend to be short-lived. Fees, on the other hand, stick around like a scar.
It's like those funds that keep growing until they're just too big and too expensive to effectively manage. The text really lays out this herding behavior among fund managers too, where they all end up with nearly identical portfolios, which really stifles genuine performance.
Right, exactly. That herding phenomenon is so pervasive that it underscores the value of seeking diversification through low-cost index funds. Yet, I have to say, it's still a tough sell to convince an investor who's been lured by aggressive marketing.
True. And the chapter also dives into the dynamics of closed-end versus open-end funds. The point that closed-end funds, when bought at a discount, fundamentally offer more value, even if their market price fluctuates, is really a subtle but important takeaway.
Yeah, it really is. The idea is that if you buy closed-end shares at, say, an 85% value plus commissions, you're already in a better position to achieve a comparable return. It's like you're buying something on sale versus paying a premium.
Absolutely. I did notice, though, that sometimes premium closed-end funds do exist, but the text questions whether that premium is actually justified by superior management or attractive performance.
Right. And the comparison between premium companies like Lehman Corp and discount ones really doesn't support the notion that a premium automatically means better management. It invites the investor to look deeper, even challenge the notion that high cost equals high quality.
That's a key point, because if the premium isn't backed by tangible performance over the long term, you're just paying extra money for no real benefit. And that just leads back to relying on publicly available data like those detailed performance tables.
Exactly. And speaking of performance, the text really makes it clear that past performance is a poor predictor of future results. The whole debate about whether performance funds can truly sustain superior results is as futile as predicting Bigfoot's wardrobe choices at a cocktail party.
Laughs. That's a vivid analogy. And it's a reminder that if you're chasing the miracle manager who can outsmart the market consistently, you're likely digging yourself a financial grave.
Yeah, it's a recurring theme. And yet, even among professional money managers, there's an inherent tension between the allure of high fees and the duty to achieve superior returns for investors. This brings us to the final section on when to sell a fund.
Right. The advice here is interesting. It warns against selling too quickly when a fund underperforms for a few years because every fund goes through lean phases. It's about having the patience to ride through the style cycles.
Absolutely. The lesson here is that the typical investor should be prepared to stick with a fund for at least 3 years, if not longer, unless there are abrupt changes in management, strategy, or dramatic fee hikes.
I suppose that's the ultimate take-home message. Invest intelligently by focusing on costs, consistency, and the manager's alignment with investor interests, rather than chasing after fleeting hot streaks.
Right. It's almost like the intelligent investor's mantra is to avoid the flashy, the overly aggressive, and to stick to fundamentals. Low expenses, disciplined management, and the patient approach which index funds epitomize.
Exactly. And to add, it's crucial to understand that while mutual funds have democratized investing for millions of families, their imperfections mean that investors need to be vigilant about fees and performance sustainability.
Yes, and by being aware of these pitfalls, like asset elephantiasis, herding behaviors, and the risks inherent in performance chasing, investors can better safeguard their portfolios against the common excesses of the industry.
It's a balancing act, really. The text presents so many interesting facets, from the advantages of diversified funds to the risks of overpaying via load fees. This all reinforces that no tool is perfect, but understanding them can tilt the odds in your favor.
Absolutely. And even though index funds might be considered boring by some, the long-term cost advantage and simplicity they provide makes them, in essence, the wise choice.
Right. Well, this has been a robust discussion. It really highlights how layered the field of investment funds is and why an informed, cautious approach, balancing fees, performance, and risk, is so vital.
I couldn't agree more. Thanks for diving into these nuances with me today. Let's keep encouraging investors to think critically rather than just chasing past performance. Until next time. So when we look at the role of investment advisors, it's clear that investment advice is, well, quite unique compared to the rest of business operations, right? Most investors, being amateurs, really lean on professional insights.
Absolutely. It's like they're asking someone, hey, tell me how to make money, which seems almost naive when you contrast it with business advice, where profits come from one's own expertise.
Exactly. Most business owners don't exactly ask for a blueprint on how to gain profit. They just do it. But with investments, they hope that some advisor can, magically deliver above average returns. It's almost as if they expect a tailor-made profit engine.
And that's a tricky expectation. I mean, if you assume there's a normal standard income from investing, then advisors are just there to prevent mistakes, kind of like a safety net.
Right. But here's where it gets interesting. If the investor starts demanding more than the average return, then the advisor, no matter how skilled, might be promising more than it's realistic to deliver. It's a delicate balance between safety and ambition.
Exactly. And then we see the various sources of investment advice. There's the friend or relative who might know a little about stocks, the local banker, brokerage firms, even those financial newsletters and services.
Yes, the diversity of sources speaks volumes. But that also tells us that investors often don't have a systematic approach when hunting for advice.
Yeah.
They hop from one source to another, hoping to catch that elusive secret, right?
Definitely. And it goes on to suggest that unless the investor sticks with a conservative and standard strategy, he or she should have a really close, almost intimate understanding of the advisor before venturing into more creative investments.
Absolutely. For example, the idea is that once you gain experience, you can start questioning the recommendations more critically, moving, as it were, from being defensive to being moderately aggressive in your approach. It's like growing up in the investment world.
Speaking of which, the text goes into detail about how truly professional investment advisors, like well-established investment counsel firms, tend to keep things modest. They stick mostly to standard securities like leading company stocks and government bonds.
Yeah, they really don't dive into risky territory. They're more focused on preserving the principal and generating a conservative income. Think of it as safety over spectacle.
Now, what about the financial services that use bulletins and forecasts? They seem to cater to a more active, self-managing investor who is ready to do their own research.
True. Those services, like Moody's, supply valuable statistical data and market projections. But often they're also hedging their forecasts with Delphic language to avoid being nailed when the market turns. They heed the fine line between being informative and being outright speculative.
And on that note, the role of stockbrokers really stands out. They split into, two camps. The customer's broker, who takes orders, and the financial analyst, who digs into the nitty-gritty of the securities.
Exactly. What's fascinating is that customer brokers are, in a way, caught in a conflict. Their job is to earn commissions, so they may lean towards speculative advice, which, as the chapter puts it, can be dangerous if unchecked.
Right, right.
So the investor must clearly communicate that they're looking for solid defensive investments instead of just chasing stock tips.
Right. And that's a delicate dance. But don't you think that sometimes advisors might overpromise? I mean, pushing for spectacular gains is a recurring theme.
I totally get that concern. And honestly, while many advisors keep to modest promises, some do slip into the trap of extravagance. I mean, expecting high returns consistently is,
Yeah, exactly.
well, asking for trouble. It's almost like they're selling a dream instead of sound investments.
And then there's that whole portion about due diligence, the advice to trust, but to verify springs up strongly. Definitely, yeah.
Right. You should always scrutinize your advisor's background, check their disciplinary record, their registration status, and even their Form ADV documents, which are required by regulators. It's
Absolutely.
like doing a background check before hiring a nanny for your kids.
And speaking of trust, it's key to weave that with an independent judgment. So even if you trust an investment banker's recommendations, you still need to pass your own sound, independent judgment on them.
Exactly. That's one of the core messages. Investment banking itself, with its dual role of advisor and salesman, can be quite conflicted. It reminds me of that saying, never let the seller be the sole decider of your purchase.
Right, that's a solid point. What about the discussion of different advisor types, like the CFA certificate for financial analysts? That was an interesting way to professionalize the field, don't you think?
Absolutely. The introduction of the CFA as a professional standard is very reminiscent of the CPA. It's designed to raise the bar for financial analysts and, instill
exactly.
confidence in their work. It's a much needed regulatory tool in this industry.
Yet, at the same time, we see that even with these improvements, the industry isn't entirely free from unethical practices, like speculative practices that jeopardize the customer's capital.
Right, and here's where I have to respectfully challenge one viewpoint. While some might insist that these speculative practices are the norm, I think we should be cautious and not generalize too broadly. There are plenty of firms that truly prioritize their clients' safety. It's a reminder that discerning investors should really focus on reputation.
And then there's the intriguing recommendation that for everyday investors, the defensive ones, the delivery and receipt of securities should be handled by their bank. That extra safety step might seem like a hassle, but it's really about, protecting your investment.
Yes, it's so true. Handling the transactions through a bank adds that layer of security. It might cost a bit extra, but peace of mind isn't free.
Absolutely. I also found it interesting how the chapter emphasizes that if you're going to outsource your financial decision-making, you're bound to get average results, unless, of course, you're a defensive investor sticking to what's proven.
Yeah, exactly. There's no silver bullet. If you expect spectacular income or profits from someone else's advice, you might be setting yourself up for disappointment. The investor should really know his or her limits and lean towards, what is realistically achievable.
Very true. And while the aggressive investor might collaborate closely with advisors, strong independent judgment is essential. You can't just follow recommendations blindly.
Right. In fact, the text even points out that in the turbulent moments of the market, having an advisor can sometimes just be a psychological shield.
Yeah, I mean, who wouldn't
providing
want that kind of
someone
backup?
to blame instead of oneself. But it should always be coupled with personal responsibility.
On that note, it was compelling how the chapter wraps up with some really actionable advice about properly vetting your advisor. From doing online searches for complaints to asking the right, sometimes tough, questions.
Absolutely. The list of questions, like asking about their investment philosophy or what kind of fees to expect, is pretty comprehensive. It ensures that you're not just swallowing any offer that promises
exactly.
the moon. It's all about due diligence and making sure they have your best interests at heart.
And then, of course, there's the wise counsel to trust, then verify. It might sound repetitive, but it holds so much weight in an industry riddled with complex and sometimes conflicting interests.
Yeah, right. It reminds investors to never get too cozy without cross-checking credentials and performance. It's like having your cake and eating it too, but only after making sure the recipe is sound.
Exactly. Finally, the commentary from Montaigne ties it all together, doesn't it? Advising us to look inward rather than just at the heavens. It's a nice metaphor for staying grounded in your personal financial responsibilities, even as you seek advice.
Yes, that bit about the Milesian wench helping Thales reminds us that while experts may give direction, ultimately it's up to the investor to steer wisely. And then there's that part about knowing when you need help, like after big losses or when your budget is
Right,
busted.
exactly.
It brings a very human touch to all the financial numbers and classifications.
So overall, it's a rich discussion that not only dissects the many layers of investment advice, but also emphasizes personal responsibility and diligence.
Indeed it is. Balancing professional guidance with your own judgment is key. And while the advisors can provide a cushion, you got to remember that in the end, you're managing your own money and, well, your own future.
Couldn't agree more. I think that's a wrap on our deep dive into the world of investment advisors. It really gives anyone in the market a lot to think about, whether you're defensive or aggressive in your investing style.
Absolutely. Keep those questions coming, trust but verify, and always remember to stay informed about who's really behind the advice. Thanks for this conversation. Let's kick things off by diving into the core of security analysis as it relates to the lay investor, where financial analysis has matured into a well-respected discipline.
Yep, absolutely. The discussion really pivots on how security analysts examine bonds and stocks almost like detectives, evaluating historical performance, estimating future earning power, and assessing risks.
Right. So starting with, say, bond analysis, the approach involves a lot of figures like the coverage ratio, which essentially tells us how many times a company's earnings can cover its fixed charges, like bond interest and even preferred dividends.
And what's interesting is that these figures are based on a range from industry averages to like poorest year tests to see if the underlying company can handle economic downturns.
Exactly. It's like checking the strength of a building by seeing how it holds up during a storm, if it's overbuilt or underbuilt.
Yeah. Now, when we switch gears to common stock analysis, the focus shifts to valuation methods. You calculate an ideal value by estimating future earnings, which of course involves projecting growth and then applying a capitalization multiplier.
It's like projecting the earnings and then multiplying by a factor that reflects, both risk and growth potential, but it's tricky, especially with growth stocks, where the anticipated rate can push the theoretical value up to enormous levels if you assume too much.
And that gets us into the real pitfall of growth stock valuation. Because if a company is assumed to grow at, say, 8% indefinitely, theoretically its value becomes infinite. I mean, that's where margin of safety concepts come into play, right?
Exactly. So the analyst has to deliberately introduce a safety margin. It's like an engineer over-designs a bridge just a bit to guard against unexpected stresses, thereby ensuring the investment still qualifies even if growth slows.
Yep.
Now, if we look at the table breakdown for bonds, we see that industries are categorized in lines like industrials, railroads, and retail concerns, where different minimum earnings to fixed charge ratios are
and
prescribed.
that reflects, the inherent risks in those sectors. Speaking of categorization, the analysis also points out divergent treatments for things like public utilities and real estate companies, which aren't evaluated the same way as, say,
True.
industrial companies.
And then there's the fact that even as bond interest rates rise, companies still need to meet these strict coverage tests. And the analysis suggests adjustments, like using a percentage return on principal instead of just the conventional ratios.
That's a clever adaptation, but let me respectfully challenge one thing. While modifying these ratios for high interest rates seems sensible, don't you think it introduces another layer of complexity that may confuse a lay investor?
That's a fair point. I mean, the adjustments for industry specifics and changing market rates do add complexity. But really, if an investor is trying to gauge safety, a more nuanced view might actually be beneficial rather than a one-size-fits-all figure.
Indeed, the nuance is key.
Moving on to common stocks, the analysis discusses not just past performance, but also the forward-looking valuation using, well, a formula that many refer to even today. It's something like value, current earnings, multiplied by 8.5 plus twice the expected annual growth rate.
Right, yeah, that classic formula. And what struck me was the balanced view it presented, tying historical recordings to future prognostications. You have a past performance value that sets a baseline, and then adjustments based on what new conditions might alter future performance.
Exactly. And that two-part appraisal process assigns the heavy lifting of forecasting to senior analysts, while the junior analysts crunch the numbers mechanically. A bit like dividing the labor between setting up a recipe and, well, measuring out the ingredients.
Yep, that breakdown is practical. Now, coming to factors like management quality and dividend records, these are more qualitative elements. The analysis cautions that while management performance should be evident historically, recent changes might alter the outlook. Yes, it warns us against being too overly reliant on management hype, like big CEO paychecks or frequent stock option repricings, as red flags. Indeed.
Right. For instance, the text mentions how a continuous dividend record, especially over 20 years, is a plus for a company's quality. It even somewhat critiques companies that emphasize stock splits and share repurchases at record
those moves
highs.
can sometimes mask underlying weaknesses. It's interesting because while some top investors like Warren Buffett favor concentrated positions, the typical investor is advised to diversify widely.
Totally. The commentary also questions whether selectivity or diversification is truly advantageous. It's a balancing act. Another fascinating element is the industry analysis part. The analyst should keep an eye on the broader economic trends and the competitive position of the company, whether it's got a moat, economies of scale, or other advantages.
Right, like how Coca-Cola's secret formula gives it that intangible competitive edge. But then the text is also a bit cautious about over-reliance on industry forecasts, highlighting that often public knowledge already impacts stock prices.
Yes, exactly. It's like chasing a shadow because the market might have already factored in those expected trends. Speaking of numbers, the analysis details the bond analysis table with different thresholds for industries. For example, industrial companies require around a 7 times coverage of fixed charges.
That's really a key metric to ensure there's ample cushion in tough times. And if we zoom out to the overarching theme, both bond and stock analysis emphasize the importance of past performance as a guide, but also caution that past performance isn't a guaranteed predictor of the future. Yeah, it's a call for a measured approach, blending rigorous number crunching with a healthy appreciation for uncertainty. Correct. And it essentially advocates a balance between two mathematical and two subjective assessments.
One section I found particularly insightful was on capitalization rates for growth stocks. It illustrates that as you project higher growth under the formula, stock values can skyrocket, which then requires extra caution by the investor.
Definitely, because overestimating growth can lead to overpaying, right? And then there's the commentary on putting a price on the future that extends the discussion beyond just raw numbers to consider management strategy, dividend policies, and even the potential pitfalls of relying on other people's money in acquisitions.
Yeah, those red flags like serial acquisitions or overdependence on debt really tell you a lot about future risks. And on that note, it also emphasizes the importance of reading annual reports or even downloading 5 years' worth of 10K filings nowadays.
Right, because digging into those details exposes trends and potential problems that might only be hinted at in summary reports. Exactly. And the text offers concrete advice like looking out for corporate bulimics, companies that acquire just too much, only to later offload at losses.
Yep, it's like eating too much fast food. You end up with a messy situation. Shifting gears a bit, the analysis also covers how interest rates, financial structure, and cash flows factor into the reliability of an investment. It underscores that good companies generate more cash than they consume.
And that concept of owner earnings really rings true for long-term investing. And that ties neatly back into the stability test discussed for bonds, where a stable historical record can indicate what might be expected in the future despite volatility.
Exactly, it's all interconnected. There's also an interesting critique in the commentary about reliance on mathematical models for projection, acknowledging that the models can be less reliable the further out they try to predict, especially in times of drastic interest rate swings.
So the bottom line is a healthy dose of skepticism is necessary. Right. And while the formulas provide a framework, the unpredictable nature of business and market changes means that investors must remain vigilant and flexible in their assessments. Absolutely. It's like using a map. Helpful, but not a substitute for actually watching the terrain. Yeah, exactly.
And then, coming full circle, the analysis makes a strong case for a systematic two-part appraisal process. First, calculating a past performance value, then modifying it based on anticipated future shifts.
Right, and that approach promotes transparency in analysis and helps avoid arbitrary conclusions. One thing I appreciate is that even though the material is dense and highly detailed, it fundamentally centers around providing practical tools for the lay investor to distinguish superficial from solid analysis.
That's what makes it enduring, empowering investors to think critically. It ultimately encourages investors to not just rely on headline figures or market hype, but to really dig into annual financial reports, understand how well a company is managed, and determine if its fundamentals kick in to back up its lofty market price.
That kind of diligence is more essential than ever. Also, don't you find it interesting how the discussion of dividend policies has evolved over time? Companies that retain earnings for growth versus those returning profits to shareholders via dividends. Each strategy has its own implications for valuation. Absolutely. And the analysis points out that a continuous long-term dividend record can be a beacon of stability. A reliable payout really signals solid fundamentals.
And it's important to note that while mathematical techniques are invaluable for objective analysis, so are the qualitative factors. In that sense, a balance is critical, and the text really captures that dual nature of security analysis.
That interplay of hard numbers and soft judgment really defines both the art and science of investing. As a final thought, blending these rigorous tests with a vision for future possibilities makes for a robust defense against overpaying for growth that might never materialize. Right. It's about not being seduced by unrealistic projections while still seizing golden opportunities when they arise. Exactly.
So, for any lay investor out there, the takeaway is clear. Understand the fundamentals through both historical evidence and future potential. Apply a disciplined two-step appraisal process, and always be mindful of the market's narrative versus the rigorous financial data.
Yeah, that's the essential message. And that, in a nutshell, is why a blend of analytical strategies and common sense remains indispensable in navigating today's complex market.
Yep, a good mix of numbers and intuition and a healthy dose of skepticism is key to safeguarding investments. Welcome to the podcast. Today we're diving deep into the intricacies of per-share earnings and the accounting practices that can really muddy the waters for investors.
Right, there's so much here about how 1 year's earnings can be misleading if you just look at the headline numbers.
Exactly. I mean, the main idea is that you shouldn't take a single year's earnings as gospel because there are, well, layers of adjustments, like those footnotes with special charges or even things like dilution that hide behind the basic per-share figure.
Yep. And speaking of dilution, it's interesting how, for instance, Alcoa's report shows multiple earnings figures, primary earnings, net income after special charges, and those fully diluted figures. How do you think investors should figure out which one to trust?
Well, it's like trying to decode a secret message. You see, the primary earnings might be $5.20 per share, but when you account for dilution, like convertible bonds, adjustments are made, and then you see another figure entirely. The investor must really peel back those layers by checking the footnotes, which, by the way, sometimes occupy more space than the numbers themselves.
But wouldn't you say maybe that overemphasis on short-term quarterly or annual figures only adds to the confusion? Investors might miss the long-term performance, right?
Absolutely. It's like they say don't take 1 year's earnings seriously because if you look over, say, a 7 or 10-year average, you smooth out all those bumps. special charges, deposit adjustments, and even shifts in depreciation
Right.
methods.
I find it fascinating that companies sometimes use special charges to essentially preload losses into one period, almost like cleaning the slate for future profitable years. But isn't that a bit deceptive?
Oh, for sure. Take Alcoa, for instance. By charging special items like closing down divisions or phasing out subsidiaries in a recession, they get to avoid the mess in future years. It's a neat trick, but it can be misleading because it hides the actual operating results.
Yeah, that's a clever yet concerning move. And then there's the matter of average earnings. The suggestion to use averages over long periods. Do you really think that balances out the effects of all these unusual items?
It does to some extent. Averaging earnings over, say, 10 years can help integrate those fleeting special items and give a better picture of a company's earning power. But, that assumes the future will mirror the past or that the anomalies
Though
cancel out
sometimes it might
neatly.
mask a worsening trend hidden under past glory. Exactly. I mean, if a company had solid growth historically, yet the market still prices it low because of short-term headwinds, then the averaged figure can be a double-edged sword.
Absolutely. And speaking of growth, the text uses Alcoa's performance versus Sears and the DJIA as examples. Alcoa's past growth was exemplary, even though its market price didn't reflect that, selling at a low multiple compared to, say, Sears. It's quite contradictory.
Yeah, it shows how perceptions of future earnings can diverge from actual past performance. I also noticed that the chapter talks about calculating growth by comparing averages from recent years to those from 10 years earlier. Isn't that somewhat simplistic in the face of special charges affecting those averages?
Well, it's a pragmatic approach. It smooths out distortions from one-off events. But, there is a risk. If those special charges are significant, they might skew the picture too. You could say it's like trying to average out stormy weather with sunny days and expecting
True, and that's where a
perfect climate
discerning investor
predictions.
has to read the fine print. And on the topic of the fine print, the chapter is adamant about reading footnotes carefully. They even suggest starting at the back of the report. Do you think that's practical advice for average investors?
It really should be part of every investor's toolbox. Footnotes might seem mundane, but they often contain critical details about revenue recognition changes, adjustments in depreciation methods, or unusual items like those special charges we discussed. It's like the difference between seeing the tip of an iceberg versus the whole massive structure underneath.
No doubt about that. Now I have a point here. When we talk about pro forma earnings later in the chapter, the text essentially argues that investors should ignore them completely. Don't you think that's a bit too dismissive? Could there be cases where pro forma might actually offer some insight?
That's a fair critique. While in theory pro forma earnings are meant to show what earnings would look like absent one-time events, in practice they are often abused. Companies can manipulate these numbers to give an overly rosy picture. So the advice is to be extremely cautious, if not to disregard them, because they can easily be, whipped up to mislead rather than to inform.
Exactly, it's like showing only the sunny hours and hiding the stormy back end. And then there's the aggressive revenue recognition examples, like at Quest. It's almost a signal that behind those headline figures, accounting practices can be downright creative in a misleading fashion.
Yes, Quest's case is almost like a textbook on how not to overstate earnings. Recognizing revenues too early or changing the accounting principles can inflate the numbers artificially. It's a reminder that as much as we love headline figures, we have to dig deeper into how those numbers are arrived at.
Right, the devil is in the details always. And what about capitalizing expenses, like with Global Crossing? Shifting costs from operating expenses to capital expenditures can turn apparent losses into profits. That seems like a fundamental accounting maneuver that investors really need to be on guard for.
Absolutely. Switching normal recurring expenses into capitalized items not only inflates current earnings, but also creates future depreciation charges when those capital assets are amortized. It's It's like painting a facade that temporarily hides the true expense structure of the business.
And that definitely can affect stock valuations. And then we come to the inventory story with Micron, where write-downs weren't just a one-off event. They became a recurring business nuisance. How do you see that affecting investor sentiment?
With inventory, a write-down signals that the company is not managing its supply chain or its pricing strategy well. Initially, it might be chalked up to a non-recurring event, but if it keeps happening, it erodes trust in the company's operational capabilities. Investors could see it as a chronic problem that hasn't been adequately
Sustained
addressed.
inventory issues can be a big red flag. Now, shifting gears slightly to the pension dimension, SBC's case is pretty striking. Earning billions from pension gains while assuming optimistic returns seems like a potential trap.
Definitely. It's almost like using a borrowed boost to inflate current performance. The text cautions that if pension benefits exceed a certain percentage of net income, say more than 5%, then investors should question whether those earnings are sustainable if
Right,
those
it's kind
pension
of like a
gains
temporary
evaporate
windfall
in
that
future
might not
years.
repeat itself, which can mislead long-term investors. And then, of course, the chapter wraps up with a caveat. Investors need to really scrutinize these numbers, read them backwards if necessary, and always check those footnotes for any hidden adjustments.
Exactly. It's essentially a call for due diligence, understanding that the published numbers might not be the final story. You have to cross-check for non-recurring items, dilution, even differences in accounting practices over time, like the choice between FIFO and LIFO for inventories.
Definitely something every investor should, seriously consider. If I may, one point I'd like to challenge. Don't you think that while this deep dive is informative, for the average investor, getting overwhelmed by every single footnote could lead to analysis paralysis?
That's a valid concern. While detailed reading is ideal, practically speaking, most investors need to balance between thorough analysis and relying on reputable analysis from experts. The takeaway is not to ignore the complexities, but to have a healthy skepticism and maybe focus on major red flags rather than deciphering every minor detail.
I can agree with that. Practicality meets diligence. And so it circles back. Despite all these complications, special charges, pro forma earnings, revenue recognition tricks, the ultimate goal remains to gauge if the stock offers good value relative to its true earning power, right?
Precisely. At the end of the day, it's about ensuring that the market's price-to-earnings multiple is supported by a genuine understanding of the company's operations and future prospects, even if that means looking through layers of accounting artistry to find the real picture.
Yeah, and sometimes that real picture can be obscured by creative accounting. It seems like for investors, the mantra should be, look past headline figures, dive into the accounting policies, and always be on guard for those subtle red flags in the footnotes.
Exactly. Read the statements backwards, take note of the footnotes, and remember that even the smallest adjustments can have outsized impacts on how earnings are presented versus how they really are. It's all part of the intricate dance between corporate accounting and investor perception.
I also appreciate the humorous touch in the commentary. You can get ripped off easier by a dude with a pen than you can by a dude with a gun. That really drives home the point that sometimes the most dangerous weapons against investors are those fancy financial statements.
Right. It's a stark reminder that, accounting tricks are weapons too, and they're deployed by folks whose only goal is to make their numbers look pretty. You have to be vigilant, almost like a detective piecing together a puzzle.
Oh, for sure. Like following breadcrumbs through a maze of numbers. And with the ever-evolving nature of these accounting practices, even the methods around depreciation, inventory valuation, and research expense amortization, the landscape can be incredibly fluid. How can investors adapt to that?
It's like a moving target. Investors need to keep educating themselves, stay updated with trusted resources, and not simply take a company's word for it. As the chapter suggests, grabbing a few solid books on financial statement analysis and financial shenanigans can make a huge difference.
Yep, staying informed is key. So to wrap it up, whether it's per share earnings, growth rates, or all those pro forma figures. The message is clear. Question the numbers, dig into the details, and try not to let surface-level metrics fool you.
Exactly. And in a nutshell, while the numbers game is complex and at times downright deceptive, a vigilant and informed investor can peel away the layers to see the true performance of a company.
Wise words indeed. Thanks for the great discussion. Here's hoping our listeners will take away the importance of looking deeper than the headline earnings.
Absolutely. And remember, every figure has a story behind it, one worth examining carefully. Until next time, keep questioning those numbers. All right, let's kick things off with a deep dive into a fascinating analysis of 4 companies from back in the day, comparing manufacturing firms like Eltra, Emerson Electric, Emery Air Freight, and Emhart, and then moving on to a later look at some e-business stocks.
Yeah, so what really jumps out to you when you look at these 4 companies from that earlier chapter?
Yep. Well, one of the key points is the stark contrast in their price-earnings ratios. You see, Eltra and Emhart were trading at modest multiples, about 9.7 and 12 times average earnings, while Emerson and Emery were priced much higher at like 33 and 45 times earnings.
Right. That's a huge spread, and I guess the reason behind that is primarily tied to their growth figures, isn't it?
Absolutely. Exactly. It's like the market was really favoring companies with superior growth, especially with Emery showing that explosive profit growth even when it started from a really small base.
Yeah. I mean, it's almost as if the high multiples, those glamour-type valuations, were more about perceived future performance rather than what their operations actually looked like, right?
Absolutely, and that's the crux of the analysis. The underlying idea was to see how operating performance, like profitability, stability, and growth, corresponded with these market valuations. For instance, despite the high multiples, companies like Emerson and Emery had impressive returns on sales and book value figures.
And then there's the aspect of stability. They even calculated the maximum decline in per-share earnings over a decade to gauge stability, like no decline is a perfect 100% stability, which was the case for the 2 popular names.
Right on. Exactly. And when you dig into the financial condition, all of them had interesting working capital and debt ratios. Except Emery had a lower current asset to liability ratio, but that was balanced by its unique business model as a freight forwarder.
What about dividends? I know dividends can be a critical part of a valuation for conservative investors.
Good point. Dividends were another big element. Emhart, for instance, had an unbroken dividend history since 1902, which is phenomenal. And while Eltra and Emerson had good records, Emery was quite new on that front. The analysis even pointed out that the cheap pair supported nearly twice the dividend yield of the dear pair.
So essentially, the conservative investor would favor the lower priced earnings tags of Eltra and Emhart because of their solid underlying value, right?
Exactly, right. And that ties in with the 7 statistical requirements they later outlined, like adequate size, strong financial condition, a long history of dividends, no earnings deficits, sustained growth, and the right price multiples compared to earnings and net asset value.
Yeah. I also find it interesting how they caution investors not to just jump on the overhyped stocks like Emerson and Emery, despite their attractive market momentum, without understanding your own investment philosophy.
Exactly, spot on. That's the lesson. It's a bit like always checking your 6, like the Air Force saying. Even if everything seems rosy, you always got to look around for unexpected risks.
Right. Speaking of risk and momentum, let's switch gears to the section that talks about the electronic and internet age companies. There's a whole discussion comparing Emerson Electric with other dot-com era stocks like EMC, Expeditors International, and Exodus Communications.
Yeah, that's another fascinating part. So on one hand, you have Emerson Electric, the old, reliable giant. Back then, its products were kind of seen as old economy. Its stock wasn't flashy, and it lagged the market in the late 90s, yet Its underlying business was steady, with continuous earnings and dividend growth for decades.
Exactly. Right, but then we see EMC Corp. Talk about a poster child for explosive growth. Their returns were astronomical, like over 81,000% over the 1990s, and in 1999 alone, their shares returned 157.1%.
Wow, almost unbelievable. Though that explosive performance came with a catch. The stock was trading at an astronomical multiple 103 times earnings. And while revenues were soaring, there were concerns about whether such hypergrowth was sustainable.
True. And then there's Expeditors International. They were steadily growing with good revenue and EPS increases, something like 30% annual return towards the end. Even though they were less hyped than EMC, they still had a robust record and even improved their working capital ratios significantly over a few years.
Yes, absolutely. Now, Exodus Communications is a whole different beast. The stock split frenzy was off the charts, splitting 2-for-1 multiple times, which made investors feel like they were getting found money. It's almost absurd how a stock split can create that illusion of instant wealth.
Indeed. But the reality was far grimmer, right? Exodus's revenues were exploding, yet the company was hemorrhaging cash and racking up enormous debt. It ended up filing for Chapter 11, basically a dot-com cautionary tale.
Exactly. It's a classic example of overenthusiasm, investors chasing the hype without regarding fundamentals. That's what Graham warned about. Paying for future growth in advance can leave you with a harsh loss if the growth doesn't materialize.
There was also an interesting juxtaposition in performance post-1999. While Emerson and Expeditors managed some gains in the early 2000s, EMC's fortunes drastically reversed with major backslides in the following years.
Yes, it really highlights how past performance, no matter how staggering, might not secure a safe future when the fundamental business starts to falter. And look at it this way. The analysis reminds investors that the charm of explosive growth can easily overshadow serious underlying risks. You might be riding a stock with high momentum, but if the market isn't valuing the actual earning power, then you're like setting yourself up for a plunge.
True that. I have to say, though, I'm a bit skeptical of dismissing the high-growth companies so quickly. While it's true that, say, EMC's true organic growth had slowed down, doesn't that sometimes open doors for transformation later on?
Well, it's a valid angle, but in this analysis, the conservative doctrine was very clear. If you're after stability and aren't prepared for wild swings in valuation, then fundamentally strong, lower multiple companies like Eltra and Emhart offer a safer haven. Yeah, and the idea is not necessarily that all high-growth companies are inherently bad, but that the excessive valuation, like 103 times earnings for EMC or near 40 times for Expeditors later on, can leave investors vulnerable if the growth expectations aren't met.
It feels like the challenge is always balancing your appetite for rapid, potentially high rewards with the fundamental, solid performance that provides a safety cushion. That's really what distinguishes a speculator from a conservative investor, isn't it?
Absolutely, spot on. And the takeaway from both the older analysis and the later e-business commentary is the reminder: never just chase the high numbers without digging into what's really behind them.
Exactly. Totally. It reminds me of that analogy from aviation, the check six concept. Even if one feels secure because of past performance or market sentiment, you always have to look around and account for unseen dangers.
Right, exactly. And another little gem is the caution about the allure of dividend history and low multiples. For instance, while Emerson's dividends and long history of positive growth are impressive, the sheer market hype around growth stocks can make you overlook their inherent risk when valuations soar.
Yes, I get that. It's kind of like the difference between owning a piece of a mature, steady company versus a flashy startup that's booming because everyone is excited, but then it can burn out really fast.
Absolutely, exactly. Right, and in this analysis, you see that the conservative strategy was to build a diversified portfolio that meets criteria like adequate size, strong financials, and sustained growth over a decade. These are qualities that protect you even when the market takes a downturn.
Yeah, really smart. And now thinking about this, it reminds me of how today's investors face similar choices between chasing growth in emerging tech and holding steady with time-tested companies. The principles seem timeless.
Exactly, they really do. Yeah, it's kind of like an investor's roadmap. One part is analyzing historical performance ratios, like price earnings, dividend yield, and stability. The other is understanding sector trends and market sentiment. Both old manufacturing stocks and modern tech companies ultimately require careful scrutiny whether you're investing in a heavy-duty toolmaker or an internet service firm.
Agreed. Now, did the analysis mention any red flags regarding these companies that you think are still relevant today?
Indeed. Oh, definitely. One major red flag was the potential for overvaluation, like with EMC and Exodus. Even though numbers were soaring, the fundamentals weren't necessarily there. And that's something investors today need to remember in any bubble environment.
Right, exactly. It's a reminder that whether you're looking at a stock trading at 30 times earnings or one that seems cheap, you need to understand the story behind the numbers.
Absolutely,
right?
that's the essence. To put it succinctly, it's not just about the headline multiples, it's about profitability, stability, dividend history, financial strength, and, well, the market's narrative. The conservative approach is, I'd rather be a part owner of a solid business than a gambler chasing the next big hype.
Yeah, no doubt. A solid wrap-up then. While the older analysis and the later .com evaluation might seem worlds apart at first glance, both emphasize due diligence, careful risk assessment, and aligning your investments with your own risk tolerance and philosophy.
Definitely, exactly right. Right. And that's the beauty of these timeless investment principles, which continue to guide us no matter if we're talking about companies from 1970 or the .com boom.
Absolutely, yeah. Well, thanks for the insightful discussion. It's impressive how these detailed analyses still offer valuable lessons today.
Indeed, thanks for the chat. All right, until next time, stay curious and keep checking your SIX. Welcome, everyone. Let's dive into this fascinating exploration of stock selection for the defensive investor. It's like charting a course through reliable, time-tested principles for building a safe portfolio.
Absolutely. It's all about finding that balance between safety and opportunity. So what's the core philosophy behind this approach?
Well, the defensive investor is advised to combine high-grade bonds with a diversified roster of leading common stocks. The key is to make sure you don't buy expensive stocks. That is, you need to check that you're not overpaying by any proper metrics, right?
Right, and that's where, these specific selection criteria come into play, isn't it? There's a checklist of sorts that outlines everything from enterprise size to price to earnings ratios.
Exactly, exactly. We have these 7 critical criteria. First, there's the need for an adequate size of the enterprise. Essentially, companies below a certain revenue threshold, like under 100 million in annual sales, are seen as more volatile for our defensive investor.
And then comes the second requirement for a strong financial condition, where current assets must be at least twice current liabilities, ensuring a good liquidity cushion, correct?
Yes, spot on. For industrials, that 2-to-1 current ratio is full of meaning. And for public utilities, instead of that, the debt shouldn't exceed twice their stock equity, which is a measure of stability in regulated businesses.
I see. So it's very much a numbers-driven and methodical approach. But how do these criteria account for the company's performance history?
They look squarely at earnings stability, requiring positive earnings over a 10-year period and a strong dividend record, meaning at least 20 years of uninterrupted dividends. This ensures the company has navigated various cycles.
That makes sense. And then we have the earnings growth criterion. They recommend at least a 1/3 increase in per-share earnings over 10 years. It's a modest threshold to weed out companies that are stagnating, right?
Right, you are. And it's interesting because they intentionally keep the hurdle realistic. It's not about chasing sky-high growth, but ensuring that companies don't regress relative to the capital invested. Then, come the valuation requirements. A moderate price-to-earnings ratio, ideally no more than 15 times the average earnings from the past 3 years, and also a moderate ratio of price to assets.
I like that they emphasize tangible measures. But what about that blended multiplier concept? The idea that the product of the PE ratio and the price-to-book ratio should not exceed 22.5. That's a neat rule of thumb.
Exactly, it's like a built-in safety net. The argument is that if you're paying, say, 15 times earnings and 1.0 times the book value, the product is 15, well below 22.5, which implies you've got a margin of safety.
That serves as a check against overpaying, especially in markets where speculation seems to drive prices too far above fundamentals.
Indeed. Now, when we turn to practical selection, there are two diversified approaches mentioned. One is the DJIA type portfolio, where you simply purchase a miniature version of the entire Dow, and the other is a quantitatively tested portfolio, where you apply these specific criteria.
Right. So the DJIA approach is almost like buying a microcosm of the market, while the quantitatively tested one is more finely tuned to minimizing risk.
Precisely. But what becomes interesting is that when they actually applied these criteria to the DJIA, only a handful of stocks passed every test. That suggests that even within leading names, only a few meet the rigorous safety standards required for defensive investors.
That seems a little counterintuitive, doesn't it? I mean, if you're looking at blue chip companies, you might expect most in the index to qualify.
Well, here's where one can respectfully challenge the perspective. Some critics argue that these thresholds, specifically the financial strength, may rule out companies that, although large and reputable, have taken on additional debt or diluted their liquidity due to expansion.
Yeah, so in a way, the criteria might be too strict in some cases, potentially missing out on good opportunities that don't meet every single number perfectly.
Absolutely, but the whole philosophy here is to prioritize safety and to avoid the margin of error in valuation that can come from paying too high a price for future growth. In other words, for the defensive investor, safety trumps speculative potential.
I like that principle. It brings to mind the later commentary about diversifying to capture those rare superstocks buried in the broader market haystack.
Exactly. It's almost poetic. Instead of trying to pick the next unicorn like Microsoft, you spread your bets. The idea is, if you own the whole haystack, say through an index fund, you're guaranteed to catch a few needles that create enormous value.
And that's especially appealing to the defensive investor who shouldn't be gambling on a single high-risk, high-reward bet.
Right. Which is why there's also a strong emphasis on diversification, and why the recommendation ultimately leans toward owning a broad stock index, where about 90% of your stock money is kept in the index fund, and only 10% is used for selective individual stock picking.
That's an interesting split. It allows you to potentially benefit from outliers while maintaining the overall safety of the portfolio.
Correct. And then there's a whole section on public utility stocks that's really compelling for defensive investors. Public utilities, by their nature as regulated monopolies, tend to offer higher dividend returns and price stability, offering an attractive balance when compared to industrials.
I noticed that. They even mentioned that utilities often trade at moderate prices relative to book value, making them very suitable for a conservative strategy.
Yes, and when you compare the industrial index to the utilities index over time, the tables clearly show that utilities tend to have lower PE ratios and more stability. It's like contrasting a roller coaster with a gentle Ferris wheel.
That's a vivid analogy. But what about the financial companies and even railroads? How do they fit into this defensive strategy?
Great question. For financial companies, the focus remains on applying the same arithmetic criteria, such as PE and price-to-book ratios, since even banks and insurance companies can be volatile. And with railroads, the situation is a bit different due to their sensitivity to regulation and economic cycles. They're historically more volatile, so the counsel here is to avoid railroad shares unless you're absolutely sure of getting a bargain relative to their risk.
I appreciate that nuance. It shows that even among traditionally significant sectors, defensive investing really requires careful tailoring of your picks.
Totally. And then we get to some of Graham's commentary on selectivity. He argues that even if you have the best security analysts out there, trying to pick the best 5 stocks from a broad index is highly subjective. Most of the time, each analyst's list is different because market prices already reflect the consensus on future prospects.
So you're saying that ultimately, any attempt to outsmart the market by selecting a few winners might actually be counterproductive for the defensive investor?
Exactly. That's where the predictive versus protective approaches come in. The predictive method is about forecasting growth, while the protective or quantitative method is about ensuring you're paying a price that gives you a buffer against any misfortune. The defensive investor should lean much more towards the protective side, focusing on concrete, demonstrable value.
I can see that. It's a methodical, almost scientific approach, eschewing the hype and focusing solely on what the numbers tell you.
Right, and that brings us neatly to the final piece, due diligence. No matter how defensive you are, you're always urged to do your homework. That means reviewing at least 5 years of company reports, checking insider holdings, and even evaluating shareholder concentration.
That step really resonates in today's information age, where so much data is just a click away, like on Edgar or Yahoo Finance. It ensures that even if you're investing defensively, you're not completely blind to potential issues.
Exactly, and it ties back to diversification. If after all your due diligence, you decide to indulge in some individual stock picking, it's only ever a minor part of your core portfolio. The bulk should, quite simply, be in a low-cost, comprehensive market index.
It's all about having a stable, secure foundation that can weather the storms and still capture those elusive superperforms that make a significant impact over time.
Well said. In essence, the defensive investor should not be driven by the allure of quick wins, but should focus on consistent, stable returns with a healthy margin of safety. That's the heart of sound stock selection in a turbulent market.
I completely agree. It's fascinating how these time-tested principles are still so relevant and even adaptable to today's market environment, despite all the changes.
Absolutely. The core ideas of value investing, buying at a price below intrinsic value, emphasizing financial strength, consistent earnings, and dividends, all remain as important now as they were back then. It's like the principles are eternal, even if the market mechanics have evolved.
And that's what makes this approach so enduring. It's not about chasing trends, but about anchoring yourself in timeless financial wisdom.
Right, and that concludes our deep dive for today. Whether you're a seasoned investor or just beginning, these guidelines offer an excellent framework for building a portfolio that's both resilient and rewarding.
Great insights as always. Thanks for the discussion. Remember, safety in investing isn't about avoiding risk altogether. It's about managing risk through a disciplined, diversified approach.
Exactly. Thanks for joining this conversation. Stay invested in knowledge, keep your strategies clear, and here's to building portfolios that stand the test of time. All right, let's get started. So, when we talk about the enterprising investor's approach from this chapter, the first thing that jumps out is how it really distinguishes between a defensive investor's broad exclusions and the more active hunt for undervalued gems, right?
Yeah, exactly. It's that idea where one isn't just satisfied with mimicking an index like the DJIA, but wants to find stocks that can beat that average outcome, right?
Right, absolutely. See, the text really emphasizes that even though on paper it might seem like a relatively simple exercise to, say, pick stocks with low price to earnings ratios or ones below their working capital value, the reality is, with so many sophisticated analysts around, it's a tough nut to crack.
That reminds me of the analogy in the chapter, comparing stock analysts to master bridge players, juggling strategy against sheer chance. It's almost like the market's a game of bridge where every expert is discussing the same hand at the same time.
Exactly. It's like the market is structured to level out skills. With, hundreds of experts weighing in, the consensus tends to be built right into the stock price. So if you're thinking of doing it on your own, you're really trying to out-predict the unpredictable.
True. And it's striking how the text brings up the point about the inherent difficulty, even for professional funds. I mean, when these funds, with all their resources, barely beat or sometimes even underperform the market averages, it really sets the bar high for any individual investor trying to beat the market.
Right. And that's where the chapter really dives into specific methodologies like the Graham-Newman methods. They break down various operations like arbitrages, liquidations, and related hedges. For instance, arbitrages are mentioned as buying a security and selling related ones, almost like hedging internal risks.
Yeah. I found the explanation of net current asset or bargain issues really interesting too. Essentially, they're suggesting that if you can get stocks for less than a company's net current assets, you're essentially getting a safety margin that can handle market vagaries.
Absolutely. And they set practical criteria. Look for shares selling at multiples of earnings below 10, ensure that the company has stable earnings and a good dividend record, and then compare it to its net tangible assets. It's very methodical.
Right. It's like assembling a puzzle. You sift through hundreds, maybe thousands of candidates in the stock guide, and then use additional filters, right? They mention starting with a broad list and, through criteria like financial condition, earnings stability, and a modest price relative to tangible assets, narrowing it down dramatically.
Exactly. And notice how they even bring Standard & Poor's ratings into it. So you can require at least an average quality rating even after meeting the mathematical criteria. That combination of numeric rigor with qualitative judgment is crucial.
Yeah, very true. Now, something that I was thinking about, wouldn't relying solely on these quantitative filters sometimes miss the bigger picture? Like, what about factors that aren't as easily quantified, say, a company's competitive environment or its management quality?
Great point. And the chapter does caution against being inflexible. It even acknowledges that while criteria like a low price earnings multiple are a good start, sometimes a company with a deficit in one area might still be attractive if other factors like consistent earnings growth or
Indeed.
exceptional management are present.
Right, and that ties into their later discussion on special situations or workouts. The chapter outlines concrete examples, like the Kaiser-Roth and Borden deal, where the opportunity lay not in standard valuation metrics, but in an arbitrage situation during a merger or acquisition.
Absolutely. Those workouts are like high-stakes puzzles that require a very specific judgment call. They show that some opportunities can yield impressive returns, like, say, up to a 40% annual rate if everything clicks, provided, of course, you pick the right deal.
But, and here's where I respectfully challenge a bit, isn't it risky to dive into these arbitrage situations if one isn't a professional? The chapter itself admits that these are more the province of professionals with experience and judgment.
Yes, you hit the nail on the head there. The chapter is very clear that while these methods offer superior profit potential, they are not advisable for the defensive investor or the novice. It even suggests starting by practicing stock picking virtually, tracking results against an index fund before committing real money.
Right, that makes sense. It's essentially an invitation for what we might call trial by fire, but in a safe, controlled way, right? Using portfolio trackers today, like on Morningstar or Yahoo Finance.
Exactly. And then there's the idea of not putting your entire portfolio into these picks. The advice is to keep them to no more than 10% of your overall portfolio, while the rest remains in an index fund. Keeps risk managed.
It really does. And then, moving further, the chapter shifts gears and gets into the selection of secondary companies. You know, those companies that aren't on everyone's radar, but arguably might be mispriced because they're overlooked.
Yes, those are essentially the underdogs. They discuss companies like Eltra and Emhart, pointing out that sometimes a stock's poor public image can create an undervaluation if the underlying metrics are healthy.
I like that part. It's kind of a reminder, just because a stock is unloved, it doesn't mean it's bad. It might be a hidden gem waiting to be discovered.
Exactly. And then we see a bit of a pivot towards testing single quantitative criteria in stock selection. Things like low PE ratio, high dividend return, low price per share, etc. They ran tests on portfolios constructed solely based on one of these factors.
And interestingly, Even lists based on a single favorable factor tended to do better than the opposite. It's like evidence that some criteria do matter, but not in isolation. They're best when combined.
Right. It's a balance. And then they touch on performance data, how random portfolios sometimes did a lot worse than the S&P, especially when composed of smaller, lower quality issues. That drives home the point that you better avoid second-rate companies unless you're absolutely sure they're bargains.
For sure. And what about the section on bargain issues? There's that fascinating discussion on stocks trading below their net current asset value. It's almost counterintuitive that well-known companies could be undervalued, right?
Absolutely. It's almost like Wall Street's emotional condition dictates a company's value. When the market doesn't like a company, even household names can trade at a discount compared to their assets. It's a reminder that market sentiment can decouple price from fundamentals for a while.
Right on. And that example from the chapter where a company like Burton-Dixie traded at, say, 20 despite a much higher net asset value, only to later be repriced closer to book value, really illustrates that point.
Exactly. It shows that patience is key with these bargains, patience to wait for the market to recognize the true value. However, the chapter also warns that not all bargain issues recover, so diversification is critical.
Right. And then the chapter wraps up with broader reflections, like how even though many professionals don't consistently beat the market, for those who do, it's because they combine quantitative criteria with qualitative insights about management, industry conditions, and even market sentiment.
Yeah, and it also hints at the future by touching on methods that evolved over time, like looking under the right rocks or even tracking what top money managers are doing. In today's world, you can follow institutional moves online in ways that weren't available before.
That's a solid point. With all the data tools we have today, an enterprising investor can screen hundreds of companies with just a few clicks. But then really it's about the judgment call. And that judgment comes only with real experience and sometimes trial and error.
Exactly. Trial and error is almost a requirement until you find a system that works consistently for you. And I love how the chapter closes by quoting Emerson. It serves as a reminder that being independent in your judgment, even amidst the market noise, is what makes a great investor.
Yes, that independence of thought is essential. We're not just following trends, we're analyzing fundamentals, understanding the numbers, and then making a call that's uniquely yours.
Right. And to circle back, the key takeaway is that while individual stock picking, with techniques like net current asset screening, low multipliers, and special arbitrage situations, offers the potential for superior returns, it clearly demands a disciplined, patient, and methodical approach.
Absolutely. And for many people, an index fund might simply be the better, lower stress route. But for those with the temperament for in-depth analysis and who enjoy the process, these methods offer a blueprint, however challenging it may be.
Yeah, and it's also an invitation. Experiment on paper first, learn from your mistakes, and then if you consistently beat the market in simulations, maybe allocate a small portion of your portfolio to your own selections.
It's really a balance between push and pull, managing risk while pursuing those undervalued opportunities, with all the inherent unpredictability of market sentiment.
Exactly. And even when market dynamics and goodwill come into play, like those companies trading at premiums because of past momentum, it's a reminder that every data point has its context. You need to understand the situation deeply before making any move.
Well said. There's so much to digest here, and it just reinforces that successful investing is not about a single magic formula, but about synthesizing many bits of information, both qualitative and quantitative.
Right. So, ultimately, the chapter provides not only a set of techniques, but also a philosophy. Be independent, be patient, track your performance meticulously, and always be ready to learn from both your wins and your losses.
Absolutely. And that's the art of stock selection for the enterprising investor. Challenging, nuanced, and, well, a constant process of learning and adapting.
Exactly. All right, that wraps up our deep dive into these approaches. It's really been enlightening to break down these methods and see how they still resonate even in today's market environment.
For sure. Thanks for the chat. This conversation really highlights that while the market can be a tough puzzle, with the right approach and discipline, there's always room to find those undervalued opportunities.
Absolutely. And to our listeners, whether you're contemplating diving into individual stock selection or sticking with broader index funds, remember, it's all about finding what fits your temperament and letting your research guide your decisions.
Well put. Thanks for joining this conversation. And until next time, keep those eyes on the fundamentals and trust in the process.
Welcome, everyone. Let's get right into these convertible issues and warrants. They're not your everyday securities. They're like a hybrid that's part bond, part stock, and kind of, tricky.
So what really jumps out to you about these convertible securities?
Well, basically, convertible bonds and preferred stocks provide investors with it's like dual benefit, right? They get that safety of a bond or a preferred instrument, plus the sweet option, the conversion privilege to participate in the common stock's rise. But there's a trade-off, you see, because in exchange for that privilege, investors lose yield or quality.
Right, so it's a risk-return trade that isn't exactly one-sided. It's intriguing how they try to get the best of both worlds, yet sometimes end up being a worst of both worlds if not used properly.
Exactly, exactly. I mean, think about it. If a convertible is issued during a bull market, its conversion privilege can be overvalued. But then when the market goes down, that conversion option suddenly loses its attractive edge.
Yeah, that's a dangerous timing issue. And the data seems to back that, doesn't it? I recall there were tables that showed convertible preferred stocks declined, on average, much more than their straight counterparts.
Yep, absolutely. One table, for instance, compared price changes between straight issues and convertibles. And convertibles had much steeper declines, like a 30% average drop as opposed to 9% in some cases.
That's a pretty big difference. So would you say that convertibles fundamentally indicate that the underlying common stock might not be that strong?
Well, that's one way to look at it. The conversion privilege sometimes betrays a lack of genuine investment quality in the related common stock. Investors who jump into these convertibles often aren't really sold on the common stock itself. They're chasing the dual feature.
Right, they might be attracted by the idea of safety, but then lose out when the actual conversion value drops. And there's that very tricky decision point, when you actually get a profit on a convertible. Do you sell immediately at, say, a 25% profit or hold out for maybe a bigger gain?
Exactly, exactly. It's like if you hold too long, you're taking on common stock risk once it converts. There was that concrete example, a bond convertible at 25, stock goes to 30, then accordingly the convertible rises to 125, but then the stock might plunge later. It's an emotional roller coaster, really.
Yep, sometimes the investor's gut tells him to hold, and then the market turns against him. It almost becomes a psychological test, doesn't it? Like, never convert a convertible bond is the old dictum. But even experienced fund managers sometimes defy that advice when the company looks too promising.
Exactly, and I'd even respectfully challenge that idea. If you convert during a huge upswing, you lose the bond safety net. It's very much like you're trading stability for the hope of exponential gains, which might not always pan out.
That makes sense. Switching gears a little, how about the stock option warrants part of the discussion? That really seems controversial.
Oh yes, yeah. The warrants, well, they're practically described as a near fraud. They create huge paper values out of thin air and mislead speculators and investors.
Right, it's like issuing magic paper money, isn't it?
Exactly. The input even draws an analogy to Goethe's paper money in Faust, a notorious invention that eventually lost its value.
That analogy really drives the point home. And if I understand correctly, these warrants, when they're issued in substantial quantities, they effectively dilute the true value of common stock by shifting a part of its intrinsic value to a separate certificate.
Yes, absolutely. It's a subtraction from the value of the common stock, and unfortunately, many investors overlook that factor when calculating earnings per share. sometimes the reported figures overstate the true picture.
That seems almost deceptive in nature.
Right, and that's why the suggested method is to add the market value of the warrants to the common capitalization when figuring out a true market price. But many companies instead use a calculation that artificially lowers the price to earnings ratio.
Interesting. So rather than revealing the dilution, they sort of mask it. I've also noticed that warrants, when large relative to the stock, sometimes even indicate a top-heavy senior capitalization, which suggests the company should actually be selling more common stock outright.
Exactly. And that's essentially the core argument. Huge warrant issues are just a fabricative paper money maneuver that inflates market values without any backing capital.
Right, it's a financial illusion of sorts. Now, another element touched on was the appeal of convertible bonds, often described as stocks for chickens. How do you see that?
Yes, exactly. Convertible bonds, while they offer a hybrid investment, often act much more like stocks in their behavior. They're about 83% correlated to stock markets, not treasury bonds. So for a conservative investor wanting a dose of stock-like returns without jumping straight into common stocks, they look attractive.
But they still carry a risk, particularly if market conditions change. Yeah, and historically, over a long period, convertibles earned returns nearly as high as stocks, but with a steadier performance and shallower losses.
True, though, the trade-off is lower income since the interest rates on these bonds are typically much lower than conventional bonds, and then there's often that cap risk if the market rallies too high.
Yeah, they come with that ceiling on your gains sometimes.
And now, just to round this out, let's touch on the covered calls topic mentioned at the end. Covered calls are a strategy to add income by selling call options on stocks you own. It's almost like putting a protective floor under losses while collecting premium income, right?
Exactly, but at the risk of capping your upside if, the stock just rockets, right? So it's a double-edged sword. You get extra income, but you might miss out on those big gains, especially if the stock appreciates unexpectedly.
Absolutely. One might say that using covered calls is a bit like trading flexibility for immediate cash. If you're willing to sacrifice that, then it might make sense. But for many individual investors, surrendering most of the upside just isn't worth it.
Yeah, that's the crux. Less risk, but also less reward. Looking back at all these points, it seems that convertible issues and warrants require a really nuanced approach. They're not inherently bad, but context is critical.
Exactly. They might work in certain market conditions. If the underlying common stocks are strong and the conversion ratio's nice. But too often, especially in late bull markets, they betray poor underlying quality.
Timing really is everything in these cases. And what's interesting is that despite all the theoretical advantages, if left to speculators without due diligence, these instruments can lead to significant losses.
Right, exactly. Let's say the investor who bought a convertible expecting moderate upside finds themselves losing out when the stock declines. It's like chasing a rainbow knowing you might never find the pot of gold, and worse, carrying too much risk.
Yeah, and then they get caught up in the pitfalls of emotional decision-making, selling too soon or holding too long. So, if one were to advise an investor, would you say be extremely cautious with new convertibles and especially with warrants?
Absolutely. I'd say invest only after thoroughly scrutinizing the terms and the underlying stock. Sometimes exceptional convertible offerings do come along in older issues that have matured into favorable positions rather than in new flotations.
Patience is definitely key here. And what about the calculation methods? I mean, adjusting for warrant dilution versus using the company's own method. There was a clear mismatch, wasn't there?
Yes, indeed. Using the company's own calculation can actually mask the dilution effect, which is, frankly, absurd. The proper method should factor in the premium value of the warrants to show a true increase in the price-to-earnings ratio.
Exactly. You really need transparency to assess the actual value. So overall, when it comes to convertible issues and warrants, the intelligent investor should always weigh the potential upside against the inherent dilution and risk factors.
Yes, precisely. They must remember that while convertibles might offer that appealing safety plus upside attribute, they often carry hidden drawbacks, especially if timed poorly in the market.
You've summed it up really well. And in a way, the covered calls strategy at the end also reinforces this broader point. Every financial instrument has its trade-offs. You might secure a cushion against losses, but you limit your maximum gain. It's all about finding that balance.
Exactly that. And it really comes down to the investor's own objectives, risk tolerance, and market conditions. In the end, convertibles, warrants, and even covered calls are tools, powerful ones, but they need to be handled with care and a good dash of common sense.
Right. It's all a matter of being informed, cautious, and not letting greed override prudence.
Welcome to the show, folks. Today's discussion is all about extreme case histories on Wall Street, the kind that really show us both warning signs and cautionary tales in the world of finance.
Absolutely, there's so much to unpack here. These cases really illustrate extremes in corporate behavior and blatant mismanagement.
Right? Let's kick things off with the Penn Central case, the railroad giant whose stock price went from a dazzling high to nearly nothing. I mean, it's like the indicators were screaming caution, but no one listened.
Yep.
Analysts should have known that a coverage ratio of less than 2 times instead of the required 5 before taxes was a red flag.
I mean, when you look at it, paying almost no taxes for 11 years while boasting high earnings was, a glaring issue.
Exactly. And the fact that the shares were priced at 24 times earnings in 1968 surely tells us that even the best minds could be blinded by unrealistic optimism on Wall Street. It's almost as if the system rewarded ignorance.
It's a cautionary tale for any investor, even the professionals. You can see how the simplest rules of security analysis were overlooked entirely.
Then there's Ling Temco Vote. Now, this story is one of head-over-heels expansion driven by aggressive and, might I say, reckless empire building. They grew sales by 20-fold, incurring massively disproportionate debt. It's like they were on an unsustainable roller coaster where the only predictable outcome was a plunge.
Right, and the numbers speak for themselves. Debt skyrocketed from a modest figure to over $1.8 billion in just a few years, while the company's earning power crumbled.
It's almost a textbook example of how reckless expansion and indiscriminate bank lending can lead to financial disaster. Banks really handed them hundreds of millions in loans without properly checking the fundamentals.
Yes, indeed. And speaking of fundamentals, the NVF takeover of Sharon Steel is another extreme. Imagine a small company, NVF, absorbing a company 7 times its size. Sound like a smart move?
Not at all. It's like absorbing debt and dubious accounting gimmicks rather than actual assets. They use bizarre measures like offering 5% bonds mixed with warrants. And even then, the market reacted by pricing those bonds at less than 42 cents on the dollar. It was, frankly, a collector's item for financial mistakes.
That's a striking illustration of how desperate moves can devastate an investor's portfolio. Soon after, the tangible equity of NVF practically evaporated.
Exactly. And then we come to 8AA Enterprises, a case of an IPO on steroids for a company with virtually no value outside of the franchise hype. The company sold shares at $13, which then ballooned to $28, all built on an inflated future promise. But reality hit hard.
The numbers are staggering. They managed to raise money based on hopes, and investors ended up overpaying by like 10 times the book value.
Yes, and what's truly notable is that after initial excitement, the company lost millions in a very short time frame, resulting in bankruptcy. This should force us to question the role of underwriters and stock exchange houses who, frankly, failed to protect investors from the hype.
Exactly. Speaking of underwriters, it really makes you wonder, shouldn't there be stricter regulations to ensure sales are in line with real underlying earnings and tangible assets?
I totally agree. It's like a challenge to the whole system. Investors, analysts, fund managers, even bankers. They all need to take a harder look at the fundamentals rather than relying on the allure of rapid price gains and fashionable buzzwords like franchising or technology.
Yeah, absolutely. And if we bridge to more modern examples, the commentary brings in cases like Lucent Technologies and Tyco International. Do these not remind you of similar missteps?
For sure. Take Lucent, for instance. Their acquisition of Chromatis Networks for $4.8 billion, with most of that value allocated to goodwill that was more like a hope chest, is reminiscent of those wild, irrational exuberances from the past. It shows how even giants can pile on tremendous goodwill that, when reversed, nearly destroys their value.
And then there's Tyco. Their so-called non-recurring charges, moronic, chilla, and even whoopaprad charges, as they quirkily label them, demonstrate how acquisition expenses became a normal part of doing business.
Right. I mean, if every acquired company drags along hundreds of millions in extra charges, one has to ask, aren't these charges really non-recurring, or are they just a regular burden?
That's a fair point.
It's almost an accounting magician's trick gone awry.
And what about AOL Time Warner? Their so-called merger of equals ended up being a merger where AOL shareholders received a disproportionate share, only to see the merged entity wipe out most of its value.
Exactly. A merger built on misguided expectations, where the technological allure of the internet inflated the stock price to crazy levels, and then the numbers caught up, resulting in gargantuan losses and nearly 80% drop for shareholders.
And if that wasn't enough, then eToys comes along, a poster child of tech bubble excess, where, despite incredible first-day gains, the company ended up bankrupt in just a couple of years.
Yes, eToys is the irony incarnate. They sold 8% of their stock to raise cash, soared on the first day with a nearly 283% gain, but logically, the underlying business simply couldn't justify that valuation. It's like a roller coaster of hype and ultimate collapse.
Exactly. And overall, these extreme examples, from Penn Central, Lingtemco Vout, NVF, and AAA Enterprises, to the later cases like Lucent, Tyco, AOL Time Warner, and eToys, seem to share a common thread, a mix of irrational exuberance, bold but reckless financial maneuvers, and an overall disregard for simple, prudent analysis.
Right? It's like the temptation to buy into action on Wall Street overrides common sense. The speculative public is, well, incorrigible. They seem to count on short-term excitement and hope rather than proper diligence.
Yes, indeed. But here's something I find interesting. Even though we all know better, the market still embraces these extremes when there's a buzz. Why do you think that is?
That's a great question. I guess it's partly human nature, the thrill of a gamble, the allure of being right about a rising star. It's almost like our psychology falls for stories of rapid empire building and technological promise, even if the numbers scream warning. Sometimes the captivating narrative blinds us to the hard analytics.
Exactly. And sometimes, in our quest for excitement, responsible investment houses even get caught up in the hype. It makes you wonder if, additional regulatory oversight, or even something like a standardized box score for public offerings, could help keep that in check.
I completely agree. Responsible investment advisory could really benefit from more transparency, ensuring that every prospectus carries clear, comparable metrics. That might save some investors from overly hyped offerings that are, in reality, just ticking time bombs.
Right. Of course, one might argue that it's not only the fault of investment houses, the public's own greed and inattention play a huge role. What do you think?
Oh, absolutely. It's a shared responsibility. The speculative public tends to chase after action in whichever form it appears, whether it's a hot IPO or a tech bubble. A lot of times, even the professionals miss out on basic red flags. It's like our common sense gets lost in the fervor of craze, a sort of collective tunnel vision.
Yes, indeed. But don't you think there's also a cultural factor here? I mean, in financial circles, there's sometimes an unspoken acceptance of this kind of madness, and a belief that unless you are on board, you're missing out on the next big thing.
True, and that cultural momentum can be dangerous. It creates a cycle where constantly extremes are celebrated until eventually reality crashes in. Think about how these extremes have recurred over the decades. The Penn Central debacle in the 70s, the tech bubble, and even now modern controversies. It makes you question if rational investing ever truly wins out.
I'd even go so far as to respectfully challenge that notion. While irrational exuberance often seems to drive markets in the short run, robust analysis and sound fundamentals tend to prevail over the long term. Would you agree?
Absolutely, I do agree. Though it's a tough battle against the tide of hype. Over the long haul, the market's corrections on unsound principles are inevitable. But still, in the heat of the moment, it's far easier to be seduced by parallels with the famous success stories until the inevitable crash.
And that's precisely why discussions like these are so valuable. They remind us continually to practice due diligence, to look beyond the glitz, and to stick with the fundamentals.
Exactly. Whether it's the cautionary tale of Penn Central's neglect of basic ratios or the spectacular overreach of eToys, these cases serve as enduring lessons. They push us to ask the hard questions about how markets operate and where responsibilities lie.
Yes, absolutely. Well, folks, that wraps up our deep dive into these extreme cases, an engaging blend of miscalculation, hubris, and valuable, albeit hard-learned, lessons in financial discipline.
Thanks for listening. Let these lessons, with all their stumbles and missteps, guide us in better understanding the nuanced and often unpredictable world of investing. Welcome, everyone. Today we're diving into a fascinating juxtaposition of company pairs and their financial contrasts spanning decades, from conservative real estate trusts on one side to high-tech glory and woes on the other.
Absolutely. It's wild how different companies, even if they seem related by name, can represent entirely opposite investment philosophies.
Right. Take, for example, the first pair, a traditional real estate investment trust versus a volatile New York real estate conglomerate. On one side, you have a company with centuries of stable performance, moderate debt, and steady dividends, almost a textbook of conservative investing. On the other, there's a company that exploded its assets through reckless expansion, acquiring racetracks, movie theaters, even a cosmetics firm, and piling up complex stock instruments and huge debts.
Wow, it really highlights the contrast between prudent management and the dizzying heights of speculative expansion. That's a classic valuation puzzle.
Then there's pair 3 with American Home Products and American Hospital Supply. The former offered more bang for your buck in terms of earnings and dividends, even though both had excellent histories of growth since the late 50s. However, the low book value in home actually signals high returns on capital, but also potential vulnerability to shocks.
Right. So if earnings drop even a bit, that value can evaporate quickly. Yep. It's almost like Block stock was fueled by excitement rather than fundamentals.
Precisely. And if you move further along the chapter, the comparisons evolve into more dramatic modern examples. For instance, we see updated pairs comparing Cisco Systems and Cisco. Cisco soared to astronomical valuations on the promise of the internet, achieving a mind-boggling PE ratio exceeding 200 at one point.
And Cisco, a far older and steadier operation, even with lower earnings relative to Cisco, had a much more grounded valuation. It's almost as though market sentiment and the allure of the next big thing can lead to wildly divergent pricing.
Right. It's like a mental association game. Investors feel that Cisco is futuristic and exciting, while Cisco is just food delivery. Yet, when you really dig into the financials, you see that Cisco's aggressive acquisitions, significant executive stock option benefits, and a dizzying set of investments introduce huge risk if the market cools. Then there's the Yahoo versus Yum scenario. Yahoo shot up because it was added to a major index, a classic case of short-term voting by the market. Its PE ratio was astronomical, and yet, in terms of earnings, it essentially couldn't justify that hype. Yum, by contrast, had solid earnings and dividends that gave it a far more rational valuation, even though it seemed unsexy at first glance.
So essentially, the market was trading on momentum and hype for Yahoo, while Yum represented more real, tangible earnings. It's a reminder that in the short run, everyone loves a hot story, but long term, the numbers matter much more.
Exactly. And Graham always cautioned, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. We see that come into play with these examples.
That's right. Investing isn't just about riding the wave. It's about understanding what's beneath the surface.
Moving on to another pair, Commerce One versus Capital One. Commerce One was a darling of the dot-com boom, with a nearly 900% rise in stock price after its IPO, despite losses mounting. Its executive rhetoric suggested a future turnaround that never materialized, leading to a catastrophic collapse in stock value. Meanwhile, Capital One, a traditional financial company with steady credit card operations and real earnings, traded at a sensible multiple and even weathered the storm much better.
Exactly. It seems like Commerce One was sold on potential that never turned into profit, while Capital One's numbers were stable and realistic.
And then there's the odd case of Palm and 3Com. Here, 3Com decided to spin off Palm, an act that created an immediate arithmetic anomaly. Palm's market debut skyrocketed, and yet the math indicated that 3Com's other businesses would have to be worth a negative value to justify the combined share price. It's a case where market frenzy produced price distortions that defied conventional logic.
That one always makes me shake my head. It's almost comical if it weren't so disastrous for investors.
Right. Then we see the juxtaposition of CMGI and CGI. CMGI was on an acquisition spree fueled by its own soaring stock value, while CGI, operating in a more traditional industry like auto insurance, delivered steady performance with modest multiples. The so-called magical money merry-go-round of CMGI unraveled dramatically, reflecting a 99% loss in value, while CGI even posted modest gains.
It's a stark reminder that sometimes hype and risky strategies can lead to near total collapse.
Absolutely. In pair 6, with Ball and Stryker, we're again confronted with market panic. Ball, a packaging company with solid growing earnings, and Stryker, an innovative medical equipment manufacturer with impressive growth projects, both suffered declines amid a broader market downturn. Yet, each recovered, Ball more dramatically, as its undervalued status became clear, while Stryker's high multiples reflected enduring confidence despite short-term volatility.
So even during market panics, there are bargains for both value and growth investors, depending on where you stand.
Exactly. And pair 7 throws us into the complex world of conglomerates versus diversified companies. National General, with its dizzying array of warrants, convertible bonds, and multiple instruments, ended up with a true market valuation that far exceeded its book value. But that high multiplier was almost absurd. In contrast, National Presto, though smaller, traded at a much more reasonable multiple with sound fundamentals.
I'd say that almost forces analysts to choose simpler, trimmed-down businesses over overly complex conglomerate structures.
Definitely. And lastly, in pair 8, the contrast between Red Hat and Brown Shoe is almost Shakespearean. Red Hat, the high-flying Linux software developer, saw its shares rocket on the buzz of new technology, despite minimal revenues and ongoing losses. Meanwhile, Brown Shoe, a venerable company with solid profit margins and reliable dividends, languished in relative obscurity. Over time, though, Brown Shoe provided steady returns as Red Hat eventually crashed.
Versus a true steady performer.
And if we step back, the overarching lesson here is the importance of distinguishing between unrealistic goodwill valuation and a company's actual tangible performance. While excitement and speculation can drive prices wildly up or down, the investor who bases decisions on solid fundamentals and value, rather than ephemeral hype, comes out ahead in the long run.
Absolutely, I agree. But don't you think sometimes the market's wild swings also offer extraordinary opportunities if you can read the signals correctly?
Sure, I can respect that perspective, but my stance is that it's extremely risky to chase these volatile swings purely on sentiment without a solid intrinsic backing. It's like jumping on a roller coaster without a seatbelt. We might get a thrill, but then we end up hurt when the ride stops suddenly.
Totally. That's a fair challenge. Riding the hype wave can pay off if timed perfectly, but missing the fundamentals almost always spells trouble.
Right, and Graham's wisdom reminds us that while there are times when stocks are a bargain, there's never a guarantee that today's high flyer isn't tomorrow's sunk cost. Investors need to be ready for major fluctuations, as we saw with McGraw-Hill's dramatic year-to-year swings and the long-term evolution in companies' profiles over decades.
And it's those historical insights that can guide a disciplined investor towards either undervalued stocks or, at the very least, help them avoid the pitfalls of overvaluation.
Exactly. Whether it's the classic comparisons from the 1960s in the book or the modern examples from the tech boom, the core message stays the same. Always look beneath the surface numbers, understand the underlying business, and be wary when market sentiment seems to be the only driving force.
Yep, and it really underlines why due diligence is indispensable.
And what strikes me is how these pairs, despite coming from very different eras and industries, tell a coherent story about the dichotomy between stable, enduring value and the volatile, unpredictable nature of speculative markets. There's a rhythm here, almost like a pendulum swinging between hype and harsh reality.
Absolutely. It's that tension between order and chaos that every investor has to understand. One that makes the world of finance so endlessly fascinating yet perilous.
And that's the crux. Whether it's real estate trusts versus speculative real estate ventures, or high-tech giants that burn through valuation multiples, the intelligent investor must blend emotional detachment with rigorous analysis.
Essentially, it's about maintaining your discipline even when the market is screaming all sorts of things at you.
Exactly. Each pair offers a case study. You have companies that are overvalued because of untethered optimism, and those that are undervalued because of market pessimism or even neglect. The key takeaway is to always ask, what is the underlying earnings power and growth potential, rather than being swayed by the buzzwords of the future or next big thing?
Not fleeting trends.
Well, that wraps up our dive into these classic and modern comparisons. It's been a fascinating journey through stock market psychology, real numbers, and the enduring lessons of value investing.
Absolutely. Thank you for guiding us through this intricate landscape. It really reinforces why a balanced, well-reasoned approach is essential in investing.
Thanks for listening. In the end, whether you favor conservative stability or chase growth in volatile sectors, it's all about knowing when to ride the wave and when to anchor down.
Well said. Till next time, remember to always weigh the fundamentals before you vote with your dollars.
Welcome, everyone. Let's get right into the thick of it. There's a lot to unpack when we talk about the eternal clash between shareholders and management, especially around dividend policy and corporate accountability.
Yeah, absolutely. There's this idea, right, that on paper shareholders are like kings, yet in practice they're all too often on the sidelines while management runs the show.
Exactly. It's like a paradox. Even though the theory is that shareholders should give orders, hiring and firing management, demanding good performance, in reality, they rarely use that power effectively.
Right. It's as if the ideal of active shareholder oversight only comes to life when outsiders step in through takeover bids, isn't it?
Yes, absolutely. Poor management tends to eventually attract overt takeover moves by, tenant investors who are willing to shake things up. The idea that individual, everyday shareholders can really change things has been more or less shown to be a quixotic ideal.
Yeah, exactly. And that really raises the question, why don't more shareholders actively vote or challenge management if they're so dissatisfied?
Well, that's the rub. For decades, expert voices have been urging shareholders to be more engaged, to read those proxy statements and to, actually speak up. But in practice, the collective action just isn't there.
It's a kind of inertia. Speaking of proxies, those documents seem almost like hidden treasure for spotting red flags. Isn't that right?
Oh, absolutely. I mean, look at the Enron scenario. They had these disclosures in their proxy materials that should have alerted investors to highly questionable transactions. It's a real canary in the coal mine, if you ask me.
Yeah, I can see that. It sounds like the lesson there is never to ignore the proxy statement because it's packed with details on executive compensation and management's relationships that you really need to scrutinize.
Exactly, and that ties directly into dividend policy. Think about it. Management traditionally argued that retaining earnings is what strengthens the company, yet they seem to downplay the shareholders' need for a more immediate payout.
That's a tough balancing act. But then we've seen this shift where even strong companies sometimes purposely pay lower dividends to fund aggressive growth strategies, right?
Yes, it's like on one hand, you have companies that use low dividends as a signal for future growth. But on the other hand, there's a risk. If you never get tangible payouts, the shareholders' immediate income suffers.
Yeah, definitely a double-edged sword. And speaking of double-edged swords, that reminds me of the whole discussion on stock dividends versus stock splits. How do you see that playing out?
Right, so here's the thing. Stock splits are really just a change in the way shares are numbered, lowering the price per share to make them more accessible. But a proper stock dividend represents earnings that have been reinvested and then distributed as new shares, which carries a real, tangible value for shareholders.
Exactly. So essentially, a stock dividend gives you an actual demonstration of those reinvested earnings, while a split is more of an accounting maneuver?
Precisely. And there's also a tax angle here. Stock dividends can be structured in a way that avoids the double taxation that sometimes comes with cash dividends. It can even be more favorable for the investor compared to, say, the combined system of cash dividends and subscription rights,
Yeah, I get
as
that.
seen in utilities.
It's fascinating, though, that many academic analysts dismiss stock dividends as just pieces of paper, even when they offer practical benefits like easier liquidity and reinvestment options.
Yes, that's a good point. That academic critique sometimes misses the real psychological and practical impacts. Like, if you want to monetize your reinvested earnings without breaking up your original certificate, a stock dividend makes a big difference.
Absolutely. But then we circle back to a broader issue, management accountability. Graham argued it's the duty of every shareholder to monitor if management is firing on all cylinders and delivering real value.
Exactly. He pointed out two core questions. Is the management reasonably efficient, and are the shareholders' interests properly recognized? Unfortunately, too many investors rely on vague assurances or artful platitudes from management without digging into the numbers.
And that's where many slip up. Yet some might say that expecting every small shareholder to scrutinize these details is, well, a bit idealistic. Don't you think so?
That's a fair critique. It can seem idealistic to demand that all investors, even those with just a few shares, become deeply involved in corporate governance. But consider the long-term impact. If more investors acted with the mindset of true owners, even small actions could collectively demand responsible practices.
It's a collective effort. And that's why reading proxy statements is so crucial, right? It becomes a sort of early warning system, a signal that something's off with management if certain red flags keep appearing.
Exactly, and not just for spotting conflicts of interest. Look at how modern compensation practices, like the reliance on stock options, can create perverse incentives. Management might prefer buybacks over dividends because buybacks can boost the price and thus the value of their options, even if it's at the expense of long-term shareholder value.
Right, that's a classic case of misaligned incentives. Speaking of buybacks, Oracle's example really throws it into sharp relief. Issuing stock options and then buying back shares at higher prices, it's almost like a giveaway for executives while leaving shareholders holding the bag.
Precisely, and that's the sinister side of buybacks. They sometimes serve to dilute the actual benefit to shareholders while simultaneously enriching top executives, especially when share repurchase programs consume huge chunks
It's
of
absurd,
net
really.
income.
And then there's the issue of executive compensation overall, like the case with Steve Jobs at Apple, taking a trivial salary yet receiving massive rewards in jet gifts and option grants. It really makes you question whether such compensations truly align with shareholder interests.
Absolutely, it's a reminder that despite all the rhetoric about aligning management with investor interests in practice, many compensation schemes tilt heavily in favor of managers. This disconnect, as Graham warned, can cause severe misalignment between the interests of the owners and the executives.
Right, it's a wake-up call. So, in essence, whether it's about dividend policy, stock splits, or the intricacies of proxy statements, the core message is the same. We, as shareholders, need to be active and informed owners rather than passive investors.
Exactly. And that's what Graham's calling for. An ownership mindset where you, the investor, hold management accountable. It's about reading every little detail in those proxies, asking tough questions, and if needed, voting out incompetent
exactly.
management.
But here's a challenge, though. Given that many shareholders are too busy or uninterested, is it really practical to expect a mass awakening in shareholder activism?
That's a valid point. It is challenging. Expecting every investor to become a corporate watchdog is a bit unrealistic. However, if even a small but significant group takes decisive action, say by supporting independent directors who report directly to shareholders, it could usher in much needed accountability.
Yeah, I can see that working on a larger scale over time. And that's the kind of modern corporate governance we desperately need. A system where transparency and accountability are the norms rather than the exceptions.
Absolutely. It all ties back to the fundamental idea that when you buy a stock, you become an owner of the company. Your rights and your money deserve proper management and a fair share of profits through dividends or effective reinvestment.
Yep, perfectly put. So, if I may sum it up, intelligent investing isn't just about picking the right stocks. It's about being a vigilant owner, understanding dividend policies, the implications of buybacks, and reading those proxy details.
That's exactly right. It's about balancing the lure of short-term gains with the long-term benefits of efficient, transparent management. Every proxy, every dividend decision, every split or buyback provides clues about whether a company's management is truly working in the shareholders' best interests.
It really does. And perhaps if more shareholders adopted this mindset, we wouldn't have to rely so heavily on takeover bids to force change. Instead, companies could proactively align their practices with shareholder expectations.
Yes, that's the hope. A future where every investor, regardless of size, acts as an informed owner who voices a clear demand for accountability and fair treatment.
Right, that would be a real game changer. Well, thanks for this deep dive. It's given me a lot to think about the real impact of those financial policies and management practices that often seem buried under layers of jargon.
Thanks as well. Remember, the best defense against mismanagement is being proactive and informed. Keep those proxy statements and dividend policies on your radar.
Absolutely. Cheers to that.
Welcome, everyone. Today we're diving into the concept of margin of safety as the heart of smart investing. You know, it's like having a cushion to absorb any unexpected hits in the market.
Yeah, right. Absolutely. This idea of a margin of safety seems to be this constant thread throughout a lot of the analysis on bonds and stocks, ensuring you're not paying too much relative to what the underlying assets are really worth.
Exactly. The whole point is if you've got a sufficient buffer between what you pay and the inherent value, like if a business's earnings can cover its interest requirements by a wide margin, then you're less exposed when earnings dip.
And that's crucial whether you're dealing with fixed value investments like bonds or even common stocks, right? I mean, with bonds, you can actually calculate that cushion by comparing, say, the enterprise value and the debt level.
Yeah, it's like if a company owes $10 million but is valued at 30 million, then you theoretically have a 2/3 drop room before problems really bite. It's a quantitative arithmetic way of saying, don't overpay.
But with common stocks, things get a bit more complicated, don't they? You need to adjust for expected earnings and dividend yields. And the margin is essentially the difference between a stock's earning power and what bonds guarantee.
Exactly, and often the margin comes from expecting earnings to be comfortably above the going rate for bonds. For instance, if an average earning power is 9% and bonds yield about 4%, that extra margin provides kind of a safety net over time.
Yeah, although I do wonder, doesn't this rely to some extent on the assumption that future earnings won't fall dramatically? I mean, isn't that a bit of a gamble?
Good point. In fact, the whole beauty of this margin of safety principle is that it's designed to mitigate the need for overly accurate future predictions. It lets you assume that earnings might drop a little, but not so drastically that your cushion is completely eroded.
So essentially, you're paying a price today that already factors in, a possible decline in future earnings?
Yes, that's the key. Investors want the comfort that even if earnings dip moderately, the buffer, the margin, is there to keep losses at bay. It's all about ensuring that you never lose most of your capital, which is the entire point of being an intelligent investor.
Exactly. Now, let's talk a little bit about diversification as it relates to margin of safety. From what I gather, the idea is that even if one security goes south, spreading your investments over many helps ensure that overall you still come out ahead.
Precisely. Diversification is like insurance. Even with a safety margin on each individual holding, no one security is foolproof. So by owning a broad mix, say 20 or more different stocks, you minimize the impact of any one failure.
I also like that analogy using roulette. Betting on a single number gives you a huge payout, but with a negative margin of safety because the odds of losing are just too high. Meanwhile, spreading bets out can give you a small margin, which cumulatively might secure a modest profit with certainty.
Yeah, that arithmetic really drives home the point. You need to aim for that small but crucial margin on each bet, whether in a casino or the stock market. It's all about managing probabilities and consequences.
And then there's the interesting part about investment versus speculation. How do you see that distinction playing out in this framework of margin of safety?
Well, the idea is that true investing rests on hard numbers. A demonstrable margin of safety based on past records, solid statistical data, and conservative projections, whereas speculation often relies on subjective judgment and optimism. With speculation, you're like betting that you're somehow different, that you know more than everyone else.
Exactly, and that's where the risk ramps up. Speculators may feel they have the edge because they're riding trends or playing market timing, but they're often ignoring the arithmetic safety margins.
Right, and that's dangerous because, as a matter of fact, even successful growth stocks can be overvalued if you pay too much upfront. The margin of safety is always directly related to the price you pay. Higher prices mean a lower margin, no matter how good the underlying business looks.
That perfectly ties into the discussion about risk. It's not just what's out there in the market, but what risks you carry within yourself, like overconfidence and misjudging your ability to ride out downturns.
Yes, risk essentially exists inside us. For instance, if we overestimate our understanding of an investment or our ability to manage a downturn, we expose ourselves to greater harm, regardless of how well diversified or seemingly safe our portfolio might be.
Yeah, and this then becomes almost a psychological challenge. It reminds me of looking at yourself in the mirror and asking, do I really know what I'm doing?
Absolutely. It's that self-assessment of well-calibrated confidence versus correctly anticipated regret. Essentially, you must honestly evaluate how much you could lose versus how much you're prepared to handle if things go awry.
Right, and that's something that Graham really stresses. He even uses these historical examples like those real estate bonds of the 1920s and the later Depression, which initially looked safe but then were revealed to be extremely risky.
Exactly. It highlights that even securities once deemed safe can become speculative if their price completely disconnects from the underlying value. And that's why, under any conditions, you need to be very cautious about the premium you pay over value.
I recall the example with JDS Uniphase. It was a real-world lesson in how overpaying can mean it takes decades to break even if the company eventually recovers.
Right. Imagine paying a high peak price and then suffering a 50% drop in value the very first year. Even if the stock boasts a robust recovery rate later, if you overpaid, the road back to your initial investment can stretch on for decades.
Absolutely. And that's why Graham's motto, "Don't lose," is so resonant. It's about protecting your capital at all costs. You minimize the risk of a catastrophic loss by sticking to investments that offer a substantial margin of safety.
Yeah, it's kind of like nailing down a statue to keep Lakshmi, the goddess of wealth, from darting away. You literally secure your wealth by ensuring you're not paying too much, knowing that you can at least get your money back if things turn
Right.
sour.
But here's something I sometimes challenge. Don't you think that too strict a focus on margin of safety might cause some investors to miss out on exciting growth opportunities? What if the market reward is there, but the price is a bit higher than the safe margin?
Well, that's a valid counterpoint. However, the underlying principle is not to chase every hot opportunity, but to ensure that each investment carries a defensible rationale. In cases where growth stocks are involved, you would need an extremely conservative forecast to justify a higher price. And even then, you're like balancing the potential for profit against the actual risk.
So really, it's a trade-off between potential upside and the risk of a sharp downturn if things don't pan out.
Exactly. The essence of prudent investing is to secure a cushion so that if your analysis is off, even slightly, you're still protected. That's why diversification plays such an essential role. It spreads the risk so that no single misstep can be devastating.
Absolutely, yeah. Speaking of diversification, another interesting aspect was the analogy to the insurance business. By diversifying, you're essentially betting that statistically your wins will outweigh your losses. They're just averaging out favorable returns over time.
Yeah, it's like the math behind insurance underwriting. Even if one claim is high, the average is managed so that the portfolio remains profitable overall. This is exactly what a diversified portfolio aims to achieve in the investing
Right on.
world.
And then there's the whole discussion about what constitutes a true investment versus speculation. With speculation, you might have that exciting chance, but you're essentially risking everything based on optimism or perceived secret knowledge.
That's exactly it. A legitimate investment, as Graham argues, must be supported by hard figures and objective reasoning. It's not just about feeling that you're ahead of the market. It's about proving, arithmetically, that the safety margin is there.
Yeah. I also find it interesting how Graham extends this whole framework even to unconventional investments. Think about options warrants. At first glance, they seem risky, but if you can mathematically analyze the potential bull market gains against what you're paying, they can present a margin of safety too.
Definitely, and that's a neat twist. It shows that with a careful evaluation, even a security that initially appears unpromising can turn into a safe investment if the numbers work out in your favor. But this, of course, calls for like a very enterprising and experienced investor to really pull it off.
Right. And then wrapping it all together, there's this overarching tenet. Investment is a business, and you have to run it with the discipline of a seasoned entrepreneur. You know what you're doing, and never let impulsive decisions throw you off.
Exactly. It's all about knowing your business. Like, don't try to hope for huge windfalls without building your portfolio on sound, calculated grounds. It's that balance of courage, knowledge, and disciplined restraint that all comes together to make an investing strategy work.
Yeah, absolutely. And this approach really helps in handling uncertainty. I mean, market ups and downs are inevitable. Even if you get hit by a major downturn, if you have a robust margin invested in that, you're protecting your most important asset, your capital.
Right, because no one can predict the future perfectly. It's about ensuring that even if you're wrong, you're not terribly wrong. That's why, in the end, whether you're facing market uncertainty or personal overconfidence, the safety margin remains your best friend.
And isn't it interesting how that philosophy even touches on personal self-assessment? Like, risk isn't only out there in the market, it's also something you have to manage within yourself. Whether you're emotionally prepared to handle losses or whether you realistically gauge your own skills.
Absolutely. In fact, a lot of the investment wisdom here is about facing the mirror and asking tough questions. Do I really understand what I'm investing in? Can I handle the outcomes if things go sideways? That introspection is, like, just as critical as the numerical analysis.
Right, true. So to sum it up, we're talking about an investment philosophy that stands on solid numerical, conservative reasoning. It's about being businesslike, managing risk, ensuring you have that cushion, and always being honest with yourself about your limitations and the inherent uncertainties in the financial markets.
Thanks for that wrap up. And while there's never a guarantee in investing, sticking to these principles can make the journey a lot less perilous. It's like setting sail on an adventure with a well-tested map and plenty of life jackets.
Exactly, yeah. Well, this was a deep dive into the margin of safety principle, diversification, and risk, as it applies both outwardly and within ourselves. I think it really underscores that a disciplined, methodical approach is key, despite all the excitement and uncertainty that the market throws our way.
Right you are. And remember, whether it's the high of a booming bull market or the lows of an unexpected downturn, a strong safety margin reminds you to, this too shall pass.
Absolutely. Thanks for an engaging discussion. Until next time, keep your investments smart and your risk under control.